Welcome and thank you for attending my masterclass on how you, as a financial market participant, from retail investor to asset manager to financial advisor, can beat the market and, if you so choose, use the tools we cover here to scale your investment business or portfolio to 9 figures and beyond, even if you don't have an existing track record. I'm excited to get the chance to share these esoteric insights with you. The things we're going to talk about are known by very few people. I know many of you are well aware of the dysfunction and even corruption of the banking industry, how the Fed, which is effectively run by the banking cartel, creates and controls the entire money supply of the U.S., how well-intentioned financial advisors are prisoners of overreaching regulation, how unwitting asset managers continually fall victim to invisible legal traps as they try to raise money, and how all of this leads to retail investors being stuck with limited investment options that all seem doomed to fail with the next inevitable crash. When I talk to people about this subject, the typical response I get is, "That's great, but what could I possibly do about it?" Well, this masterclass will lay out exactly what you can do. We're going to walk, if not jog, through the process of how you can literally create highly valuable capital out of thin air, in almost the exact same way the Federal Reserve creates the modern US dollar. We're going to reveal the shadow banker's secrets. Now, before we continue, it might be worthwhile to click the button at the bottom that allows you to expand the video to full screen. The text on some of the slides gets a little bit small. I tried to keep it as Spartan as possible, but just a lot of information. And so you'll probably need full screen mode to be able to read all this text on all the slides. So to understand how to protect and scale your investment portfolio or business to the level we're talking about here, we have to start at the beginning with the very source of all money as we know it. Most people hold the belief that whoever has the gold makes the rules. This is absolutely not true. The reality is that whoever understands money makes the rules. And once you understand the mechanics of banking, the truth of this statement becomes absolutely clear. We don't have time to go into a treatise on the subjects of central and fractionalized banking, but in short, the money banks use and profit from is not theirs. Retail, commercial, and shadow banks effectively use the money of their depositors, investors, and the central bank to finance others. The unique quality they possess that affords them their station in the economy is a thorough understanding of the mechanics of money and their perceived ability to manage risk. Chasing money itself without an understanding of how it's created is a never-ending rat race that will always leave you at the feet of someone else who controls more. The second step to success in the investment business en route to the top of the economic food chain is understanding how the banking system literally creates money and assets out of thin air, albeit with some constraint, so you can legally do the same. I'm going to show you how. The term has been plastered all over this presentation, but what exactly is a shadow bank? Shadow banks are kind of like any other bank, except they generally don't deal with the public directly. They are subject to far less regulation, and they have the potential to be way more profitable. The shadow banking system, or shadow financial system, is a network of financial institutions comprised of non-depository banks, for example, investment banks, hedge funds, structured investment vehicles, money market funds, and other non-bank financial institutions. Shadow banking institutions generally serve as intermediaries between investors and borrowers, providing credit and capital for high net worth individuals, institutional investors, and corporations, and profiting from the fees and or from arbitrage and investment yields. How would your portfolio or business change if you were your own shadow bank and able to provide yourself access to as much capital as you could responsibly use? The purpose of this presentation is to show you how to do just that while being fully compliant with all relevant laws and regulations. And to tie everything together at the end, as the last thing we discuss, I'll show you a phenomenally powerful 5-minute concept that will change the way you think. Let's begin. What makes this different? This is fairly complicated subject matter. If it wasn't, it wouldn't be valuable. Every detail in this presentation matters, so stay focused and don't let this extraordinary opportunity be lost on you. To get the most out of this presentation, you need a pen and the Masterclass workbook you were provided to take note of all the key points that are relevant to your needs and goals. The text on some of the slides had to get a little small, as I mentioned, to fit all the necessary content. The workbook will be especially helpful when we get to those. We put a fair amount of effort into developing it. I hope you took advantage of the opportunity to download it from the confirmation page and put it to good use. As a heads up, I will discuss a few subjects along the way in fairly technical terms. Do your best to keep up, but if some of it is completely new to you, that's okay. Just take away what you can. That will be plenty for you to create your own niche. If you want to make sure you catch everything, take notes on which sections you feel the need to review and rewatch those sections, or the whole masterclass for that matter, as many times as you'd like. One point to make clear for the non-financial professionals, retail and real estate investors here, who may not be familiar with some of the financial services lingo yet, alternative assets are anything that's not stocks, bonds, and cash equivalents, which means that real estate falls squarely under the category of alternative assets. So when I say alternatives, I'm including real estate. That being said, who is this for? Well, alternative investment sponsors, including real estate investors, asset managers, lenders, and syndicators, whether you're new or you've been doing it for quite some time, who want to protect their business from the next market crash, or who want access to unlimited capital to execute their investment business on their own terms. Retail investors and savers, those who aren't financial experts, such as retirees, who have a nest egg they need to generate decent income from or grow, but who can't afford much risk exposure, and who want to meaningfully improve their portfolio and or replace their financial advisor. Financial professionals who want to create competitive advantage by incorporating reliable, quantifiable investment risk measures and alternative assets that generate demonstrably superior risk-adjusted performance into their practice. Real estate agents who want to compliantly serve their investor clients in search of returns that are not available via the MLS or CoStar and are in need of 1031 assets or prefer quality passive investment opportunities, and who want to develop a niche as the investment real estate consultant in their market. Independent insurance agents, IRA custodians, accountants, attorneys who want to compliantly serve their clients in need of better investment options than what they are being offered by their financial advisors or otherwise have available through their retirement accounts. And relationship builders in general who want to serve and monetize their network by compliantly providing exclusive access to high-quality alternative investments like top-performing hedge funds. So in other words, literally everyone has the potential to greatly benefit from what we're about to cover. It's just a matter of having the wherewithal to recognize the value for you. I know quite a few of you are already successful syndicators, and you may be tempted to believe that represents the ceiling for your business. It's not. There are subtle but very important distinctions to make between legitimate shadow banking financial institutions and syndicators who raise money for real estate, energy projects, or otherwise on a deal-by-deal basis. It's these distinctions that allow financial institutions to access the capital markets in ways syndicators can only dream of. In other words, these distinctions are some of the biggest reasons why credible financial advisors won't even consider working with most syndicators in their effort to raise money. So here we have a chart of syndicators versus financial institutions. And here we have a summary of the what, the how, the who, and the why. But I think the most important takeaway here is the how and the who, meaning that syndicators typically profess to know the future. They sell what they expect the market's going to do. They tend to expect it's going to forever increase in value. And that is generally the limit of market risk, which is very limited. With legitimate financial institutions, risk management is much more rigorous, meaning that there is a look at the operational infrastructure and all of the qualitative components that go into being a responsible steward of the public's money. But further, there's a look at the historical market and the potential volatility in the market when planning their investment strategy. So hedge funds utilize risk engineering skills to generate market neutral performance. Private equity funds buy and sell businesses that operate and succeed largely independent of macro influences. And investment banks have a little bit different perspective, but their underwriting, as you might imagine, is extraordinarily rigorous and accounts for every possible variable that you could identify. And the result is, while syndicators tend to be stuck selling to their friends and family in terms of raising money, financial institutions access the capital markets at large. And so that's what I want to provide for you syndicators, is the ability to transition your operations from being pigeonholed into friends and family to reaching out and being able to access the entire capital markets by being responsible risk managers. How nice would it be to go from a syndicator, again, just stuck with friends and family, begging for money with each new deal, to being a financial institution who's like, yeah, I'll take the money you're trying to throw at me when I feel like it, but I don't need it right now. If you're not sure, I'll tell you. It's nice. I know we have more than a few credentialed professionals in attendance who aren't new to investing and have quite a bit of experience with alternative assets. So I thought this statement by Frank, who is a CPA and runs a successful financial planning business, was important to highlight to demonstrate what we're going to cover is comprehensive in nature. My goal in designing this masterclass was to provide you valuable, actionable items that all financial and investment professionals can use to dramatically scale their business. Alternative assets are just a tool, and to date, a grossly underutilized and misused one. So that begs the question, to what extent do you want to scale? How much money do you need to fulfill your business potential? 10 million, 100 million, a billion, 100 billion? Are you a multifamily syndicator who wants to become the dominant player in your MSA or nationally? How much money do you need to accomplish that? Are you a financial advisor working to scale past 100 billion in AUM? Are you just starting out as a real estate investor and need available capital to flip houses in your local area? Are you a private lender wanting to achieve institutional scale? How about a hedge fund manager trying to achieve Ray Dalio status? While it may sound like fluff, largely because of all the insincere people pushing the idea, it really is important to clearly identify your ultimate goals without fear of failure and visualize the details of achieving them. We used visualization in my days as both a college and professional athlete, and its value holds in whatever goal you're working to achieve. Not only does it remind us of what we're working for, a sort of motivational tool, but it also helps to keep us on track with our purpose. I think this quote that was frequently echoed by one of the best coaches and most successful people of all time, Skip Bertman of LSU, who won 5 national championships over a 10-year span, really sums it up. Anything you vividly imagine, ardently desire, sincerely believe, and enthusiastically act upon must absolutely come to pass. The key word here is anything. While this image shows a pile of money, your vision of success can be anything. The point here is that you need to make the effort to formulate a clear vision of what your success looks like. That being said, how much capital do you need to achieve your professional goals and fulfill your potential? Once we've identified what we want, we now have to dive into the how. What is your exact plan to achieve your goals? While vision is an important step, it's only the first one. We next have to achieve belief. True belief, as opposed to hope, only begins to form as vision evolves into a mission, as specific goals and objectives grow into something we can begin to enthusiastically act upon, ultimately implementing the strategy and tactics that will get us where we've decided to be with consistency. Belief is forged by repetition. I know a lot of you are already successful in your own right, but to achieve a truly uncompromised level of success means to take on new goals, new skills, and new efforts. In some respects, this can be more difficult than what was required to even get where you are now. We're talking about becoming leaders in value creation and taking on a great deal of misguided cultural inertia in the process. That being said, I've successfully done it, and whether you're a real estate investor, an attorney, a financial advisor, or otherwise, you can too. I want to set clear expectations. My goal for this masterclass is to demonstrate the following. First, the only way to achieve complete financial independence is to possess the ability to create and control unlimited capital. Secondly, the only way to acquire the ability to create and control unlimited capital is through the closely guarded secrets of the shadow banking system that I'm going to reveal to you today. As I previously said, we're going to discuss exactly how you can effectively issue and control your own money. So continuing with a little more detailed look at my objectives for this masterclass, I'm going to reveal how to choose and even create investments that generate strong returns even when the market dips. In other words, show you how to consistently achieve better risk-adjusted returns than what's otherwise available through the public financial markets. Secondly, I'm going to open your eyes to how you can use these investment management skills to meet the approximate $20 trillion demand for other investors in desperate need of strong risk-adjusted returns. In other words, show you how to raise unlimited capital by issuing private securities that compete with the best hedge funds in the world. And third, to demonstrate how you can use your unique resources and skill set to profit as an investment professional. Whether you are the technical expert who can create great risk-adjusted investment returns for yourself or others, or a relationship builder who can aggregate capital. Now, despite the fact that just a few slides ago I went over all the various types of professionals this discussion is meant for, there are a few people, especially traditionally oriented financial planners, captive insurance, and real estate agents, who are going to see some of the topics I go over as somewhat unfamiliar and complex, and kind of want to switch off. Trust me when I tell you this stuff is for you, and you probably need it more than anyone else. You're stuck in a field forced to sell the same exact products in the same exact way as the thousands of other brokers and agents in your completely flooded markets. I implore you to overcome that knee-jerk reaction and open your mind to the possibilities that are available to you by taking advantage of the untapped resources at your disposal and looking at things from a little different perspective. To provide a bit of context with respect to the value of what I'm going to go over, for us to refine, structure, and capitalize our clients' alternative asset management businesses, it costs them a minimum of $750,000. And for more complex solutions, costs can exceed $5 million. Now, that being said, it's important to note that all upfront fees paid by our clients are reimbursed by the structures we create. The result is that our clients ultimately incur no expense to have us scale their business to 9 figures plus. But the point here is that they're still fronting over $750,000, oftentimes much more, for the information that I'm providing you here. All that being said, and somewhat tongue-in-cheek, don't use what you're going to learn here today to become just another evil bankster. As the old adage goes, with great power comes great responsibility. In the wrong hands, for centuries, we've seen these esoteric skills used to literally enslave nations, but there's absolutely no good reason to use what we're going to discuss here today for anything other than to create substantial wealth for both yourself and your investors by running a good business. The first step to success in the investment business is to completely and competently protect other people's money with even more tenacity than you do your own. Just in case it's not obvious already, What I'm introducing today is nothing like anything you've ever seen, whether you're a financial advisor with $1 billion AUM or real estate guru. And that's the reason for sharing Ryan's comments here, to highlight this fact. Ryan runs one of the most sophisticated real estate investment associations in the country, and I have a great deal of respect for him. So for him to say that every time I talk to Ben about money, finance, risk, and investing, I always learn something new, he's incredibly insightful, that means something. I also share Ryan's comments to help set expectations. This subject matter is fairly complicated, but it's not beyond the reach of new investors, agents, and financial professionals who are smart and driven. So like I said, you can use the secrets we're about to discuss to simply improve the performance of your personal investment portfolio or to create millions, if not billions of dollars running your own firm. But, as you might expect, the bigger your goals, the more commitment and effort will be required to achieve them. When I started out as a professional investor in 2005, my goal was to simply run a business to replace my income as a corporate employee. The more work I completed toward each successful goal along my path, however, the more money and professional pride I saw could be attained. My motivation and commitment grew commensurately, and I expect the same will happen for you. These pictures of my beautiful significant other Daniela with me, my adorable daughter Lauren, and this group shot at a polo match in Wellington begin to capture why it's worth it to me. Making the effort to be able to literally dictate my net worth provided me a conduit to doing great things with great people and the ability to have the life I want on my terms with the people I love. The same effort applied to what I'm sharing with you today can provide you the same results. I think there are a few reasons for taking a couple of minutes here to introduce myself and to go over how I arrived where I am now. First, it's important to see that you don't have to have an Ivy League MBA or be a Goldman Sachs alum to successfully operate at the top of the finance game. Secondly, my background serves as a practical reference for you to get where you want to be, no matter where in your journey you are right now. It demonstrates that the places you're going to find the most valuable lessons are not where you typically think to look or where others might expect. As you've probably gathered by now, I'm Ben Summers, the founder and managing director of Adagio Group. I grew up just outside of Baton Rouge, Louisiana, with one single passion: to be a successful athlete. And relatively speaking, I was. I overcame a career-ending shoulder injury and surgery in high school to have the opportunity to play both football and baseball as a quarterback and pitcher at the Division 1A level in college, went on to sign with the San Diego Padres organization, was an opening day starter, and won a minor league championship. Since then, I've also had the chance to work side by side with Hall of Fame wide receiver Chris Carter and other greats to train prospective high-round draft picks for the NFL Combine in preparation for the draft. As my baseball career was winding down, I finished up my degree at LSU. I majored in physics and studied music, piano performance, music theory, and composition as a second discipline. When my baseball career was finally over, the next biggest challenge was to find something else that would get me as motivated as sports had. I was miserable in my new existence. That was little more than a hunt to pay rent and bills. As a default, my post-athletic career started as an engineer in the oil and gas services industry. My first stop was a one-year stint in Houston building refinery additions for Shell. Then I moved on to developing Shell's natural gas infrastructure in West Africa before finally moving to Northern Europe, splitting time between Aberdeen, Scotland and Stavanger, Norway, bringing new drilling technologies to the global upstream market. I learned a lot about the nature of corporate business during that time, but the most valuable lesson I learned was that subjecting myself to the political bureaucracy of corporate life was no way to live. Don't get me wrong, there was really great stuff about that experience, not the least of which was being able to travel the world with a seemingly endless expense account. But I was owned, and that was something I could not abide. My oil and gas experience had uncovered a new passion, the pursuit of financial independence, so I decided to go out on my own. I knew that one of the biggest challenges in starting a new business was startup capital. And of all the industries to get into, real estate investing provided the greatest opportunity for leverage, which minimized the startup capital burden. Once the decision to pursue investment real estate was made, I spent all my spare time in the waning days of my energy services career reading everything I could get my hands on that discussed the topic of real estate investing. You may find it surprising that I think Carlton Sheets' No Down Payment course was by far the most comprehensive and valuable information on the subject available at the time, and it probably still is today. I don't understand why so many people dismissed his content. I suspect that the typical corporate employee is unconsciously trained to value a very narrow marketing approach that is dependent upon well-established branding. One thing I can attest to firsthand is that corporate indoctrination instills a false sense of confidence and ignorance that makes moderately successful people highly overconfident in what they know and averse to the information they often need the most. I think that dynamic highlights the need for and value of a masterclass like this one, as a necessary tool to re-educate the market on how to adopt innovation as a means to create value. So with that, Adagio LLC was born in Houston on May 11, 2005, as a single entity real estate investment company that operated in both Florida and Texas. It didn't take long after diving into real estate investing, however, to realize that there are not very many really good deals available at any given time, and there are a lot of deep-pocketed, well-established investors chasing them, many willing to overpay. The result is that most new investors are stuck either overpaying for assets or experiencing very limited deal flow. Another thing I discovered was much more encouraging: the hard money lender. It was immediately clear that these lenders had the best perch of everyone playing in the real estate game. Not only were there an endless stream of deals being brought to them, but their returns were in the high teens, and they had a significant equity cushion protecting their position. So that's the perch which I quickly moved to position Adagio. The only problem with becoming a lender is that it takes a lot of liquid capital to execute, much more than I had at the time. So to successfully transition Adagio from a real estate acquisition to real estate lending firm, I was going to have to raise money from others. While this is not an easy task, the good news is that there's an entire sector of the economy dedicated to this endeavor: financial services. So if I was going to be successful, I was going to have to learn the business of finance. And that's what I did. The first move I made was to bring in Carl Moore, who not only holds a securities law degree from Vanderbilt, but has also worked as an investment analyst for a range of hedge funds and investment banks. Together, we developed Adagio into a formal fund manager, positioning us to launch the asset-based lending, or ABL fund. Meanwhile, I dove into the best finance texts available, including the CFA manuals and Nassim Taleb's and Certo, paying special attention to tail risk management. I explored the application of my mathematical physics skills to quantitative finance, poured over all the federal securities laws, and acquired a Fender Series 65 along the way. In addition to the general finance knowledge I acquired with that effort, I uncovered what is arguably the most important graph any real estate market participant could ever get its hands on. It was a graph of BLS and FHFA data that illustrated how real estate could be managed to consistently generate double-digit returns no matter how the market was doing. This new insight was tested with the 2008 financial crisis, and it passed with flying colors. But more on that later. To this day, I continue to be awestruck by how far ahead my independent study has put me relative to almost everyone else I meet who has been formally trained in finance and has spent years at one of the big wirehouses. The lesson here is that when you learn something because you want to, as opposed to because you have to, because you see the direct benefit it will afford you, the more it will stick with you, and you'll integrate what you've learned into how you think and make decisions. Knowledge becomes far more than something purely academic that is required to be regurgitated solely for the purpose of passing an exam. Knowledge becomes the foundation and means of your profitability. In other words, passing on an Ivy League MBA or that entry-level analyst position at Goldman Sachs does not seal your fate or limit your potential. You can read a book without the supervision of faculty. You can do work without a boss, and it all still counts, and potentially more so. The information you need and work required to achieve anything in life exists independent of the medium through which it is delivered. You are able to learn everything you need to rise to the top of any profession, at any time and in any place. All you really need is the will to do so. As I mentioned in the last slide, raising money is not easy for a small asset management firm. And by small, I mean managing under $100 million in assets, even when you do know the game. In fact, the more you know, the more you realize how constrained you are as a legitimate private fund manager in your efforts to raise capital. As a circuitous means to get our message to the market and establish credible brand awareness, I developed a comprehensive course that distilled everything both passive and active investors need to know about finance and real estate so they'd be able to take advantage of the best of both worlds. I called it the Accredited Investment Professional, or AIP course. In addition to helping students achieve their individual investing goals, the AIP course served us in a few different ways. First, it educated potential borrowers from our ABL fund to help them become better positioned to borrow from us. And secondly, it educated potential investors in our fund on how to evaluate and compare both public and private investment opportunities. And third, it helped us establish pre-existing relationships with those potential fund investors so that we could maintain our Reg D 506B exempt status, which prohibits general solicitation. One day I received an inquiry that seemed a little different from others. Our course marketing had landed in the hands of a multifamily deep value add operator that was in desperate need of our help. They were being investigated by several states in addition to the SEC for illegal fundraising activities. And to make matters worse, their portfolio was insolvent, meaning they owed their debt investors more than their assets were worth. You'll have an opportunity to access this case study anonymously, detailing the circumstances and the mechanics of how we rescued this firm from the brink of bankruptcy and prison to compliantly and profitably raise approximately $5 million a month later on. Long story short, however, after a year of working to restructure their capital stack and methods of raising money, Adagio came out the back end, having evolved from a fund manager to a de facto boutique investment bank. I should note that, legally speaking, Adagio Capital Management, a subsidiary of Adagio Institute, is an investment advisor only and not a broker-dealer, which means that in the strict technical sense, we are not an investment bank as defined in most legal contexts. Regardless of the semantics, we work with cooperating broker-dealers to compliantly provide de facto boutique investment banking services in a turnkey capacity. So what do boutique investment banks do? Well, they can do a lot of different things, and each one has generally carved out its own niche. To provide some context, this is what we do and what I'm going to be teaching you on how to accomplish for yourselves today. Alternative asset managers and sponsors. We help alternative asset managers and sponsors such as real estate syndicators and hedge fund managers quickly raise hundreds of millions of dollars by measuring, improving, and communicating the risk-adjusted performance of their investment model, packaging it under an institutional-grade fund, and distributing that fund through the appropriate capital markets channels to meet demand. We help financial professionals quickly and compliantly grow their client base and reduce regulatory risk by definitively, quantifiably, measuring the risk characteristics of any asset, including alternatives, and providing all their clients, including non-accredited investors, access to transparent, institutional-grade, private structured products that generate better risk-adjusted performance than what's otherwise available through the public capital markets by taking advantage of inefficiencies in private markets that provide unique arbitrage opportunities via best-in-class asset managers. We help retail investors sleep well at night knowing they can retire comfortably by definitively measuring the risk associated with all of their investments, from the stocks, bonds, and mutual funds recommended by their financial advisors to hedge funds and real estate, and providing exclusive access to better risk-adjusted performance than what's otherwise only available to the top 0.1%. We help financial professionals without FINRA licenses, such as accountants, attorneys, IRA custodians, marketing firms, etc., quickly grow and monetize their client base by compliantly providing them exclusive access to the best risk-adjusted investment performance available via institutional-grade private structured products that are otherwise reserved for the top 0.1%. And we help regulatory and trade association professionals protect the investing public and support financial services professionals by providing education and guidance on quantitative risk analysis and relevant institutional grade standards for alternative sponsors and asset managers. I've just spent a fair amount of time talking about how to rise to the top of the finance industry from both a performance and regulatory perspective. But what makes me qualified to do so? Well, here you can see from FINRA's IARD system that I'm the managing director of Adagio Capital Management, which is an SEC reporting investment advisor. Our CRD number is 286131. Feel free to look us up through FINRA's broker check. Adagio has been in the business of private alternative asset management, fund management, and helping other firms navigate the minefield of capital formation since 2005. And we've continued to grow and develop in complexity since that time, as you can see on the timeline. Everything we do is public record, as reported on our annual Form ADV submissions to the SEC through FINRA. Probably most valuable, however, is the application of my academic background in physics to quantitative finance. There aren't a whole lot of quants to be found operating outside the gates of the big box firms, but I'm one. And I'm providing that skill set to you with the sole intent of leveling the playing field and bringing merit-based decision-making tools to the market. As a matter of example, I've developed a proprietary risk rating matrix that consolidates the most informative risk-adjusted performance metrics into one user-friendly output that accounts for all 4 statistical moments of risk. It's like the Morningstar for alternatives, except the calculations are much more robust. But I'll go into that a little later once we've established the groundwork for risk analysis. In short, everything I'm prescribing for you is exactly what we've done ourselves, and it's consistently proven over the last decade to be dramatically better than the run-of-the-mill approach. That was a lot to go over, so here's a snapshot summarizing where that breadth and depth of experiences has landed me. If you only take away one thing here, remember that we were able to generate high double-digit returns across the financial crisis of 2008, when just about everyone else was losing approximately half their net worth. And we've continued to do so since. Let that sink in for a minute. It's worth noting that unlike most industries, financial advisors are severely limited by the SEC in terms of being able to offer testimonials and advertising. So there's not much we can disclose in terms of past clients, but you'll see as we move on how the information we go over very much stands on its own. And that brings us to as good a spot as any to go over the obligatory legal disclosures. The information and materials herein are provided only for general business guidance. The application and impact of this information can vary widely based on specific facts involved. Furthermore, given the changing nature of laws, rules, and regulations, there can be no assurance that the descriptions and information in this presentation will remain accurate or appropriate. Accordingly, the information and materials in this presentation are provided to you with the express understanding and agreement that the authors and publishers are not engaged in rendering, and you are not relying on this presentation for any legal, financial, tax, or any other professional advice and services. You are strongly encouraged to consult with your own competent finance, tax, legal, or other professional advisor. Neither this presentation or any of its contents shall construe an offer to sell or the solicitation of an offer to buy interests in any fund or entity. Any documents such as summaries, fact cards, presentations, private placement memoranda, subscription agreements, operating agreements, etc. included in this presentation are for informational purposes only. The materials included with this presentation are provided solely for informational purposes and are not to be reproduced or distributed. So now that's out of the way. You've seen it's taken an incredible amount of time and effort to get where we are now. Through more than 10 years of tremendous effort and expense, deciphering endless financial data, applying complicated mathematics, researching cryptic securities regulation, acquiring the necessary licenses, and putting up over $1 million of my own money, I discovered how to use the secrets of investment banks and hedge funds the hard way. So now I can provide you the easy way. If you've been struggling in the past, either with sustaining a profitable investment portfolio or raising capital to grow your investment business, it's not your fault. The system is designed to beat you. I want to help you beat the system. Here's a quick breakdown of what was required to accomplish just a couple of the key milestones on my journey. So our first fund required about $70,000 in legal work for offering documents, around $35,000 to get the marketing documents pulled together, $100,000 minimum to open up our account at UBS, $175,000 retainer for placement agents and administration onboarding, 3 years of prior successful investing experience to learn the ropes, and a year of research into quantitative methods in finance. To go from the fund manager to the boutique investment bank, it took over 3 years developing operational and distribution infrastructure and an additional $1 million plus in capital investment, 11 years of developing broker-dealer and RIA relationships, and 6 years of research into securities law and banking history. I'm going to deliver all of this information and all these resources over a decade worth of dedicated effort and hundreds of thousands of dollars in one concise masterclass. Isn't that something worth your time? I've broken out everything we're going to cover into 3 shadow banking secrets. Here they are. Secret number 1, how to meaningfully measure risk quantitatively to identify assets that will best perform across market cycles, including financial crises. Secret number 2, how to quickly grow your investment portfolio to 9 figures and beyond. And secret number 3, how to be compliant as you quickly scale your investment business. Almost every real estate syndicator I talk to is breaking some securities law, and they don't even know it. Oftentimes, they've been doing it for years and don't find out until it's too late. When it finally does catch up with them, the outcome is usually tragic. On the financial services front, nearly every broker-dealer due diligence officer, or DDO, we speak with recognizes the need to quantitatively measure the risk associated with the alternatives they consider hosting on their platform, but have no means to do so. And stuck in the middle, seemingly every financial advisor has been conditioned to accept the notion that their clients' portfolios are fated to ride the inevitable peaks and valleys of the markets. Collectively, these three secrets address all the fundamental obstacles preventing everyone from financial professionals to retail investors from reaching their loftiest financial goals. So here we are, secret number one. It all starts with this fundamental question. Do you know what risk actually means? Every investor, from the guy who bets on physical currency by hiding it under his mattress to Warren Buffett, is concerned with risk. Somewhat surprisingly, though, despite the fact that the vast majority of people are risk averse, very few have any idea what risk actually means. This group includes many, if not most, financial professionals. And ironically, despite retail investors' often stated aversion to risk, they and their advisors tend to solely focus on the projected return of an investment, seldomly, never, considering the risk associated with achieving the expected return in any meaningful way. Sure, most people take a look at a few qualitative variables that may contribute to an investment's risk, but this is tantamount to seeing flour on a random countertop and walking away confident that you're going to get a delicious cake. Successful baking requires a specific recipe of precisely measured ingredients. It doesn't work if you only use a few of all the ingredients required, eyeball the quantities, and make up a plausible story about what's going to come out. If this haphazard approach isn't good enough for baking, why is it good enough for you or your client's life's savings? Before we can begin to discuss ways to effectively manage risk, we must first define it. Risk is quite simply the likelihood or probability of a negative event occurring, weighted by the potential loss associated with such an event. In other words, it is a number that can be computed, and because financial assets are measured in quantifiable units such as dollars over time, so can the downside potential. So a few of the following slides in this section get fairly technical, and it's very much okay if you don't follow all the mathematical details. The takeaway from this section is that risk is a number, and if you don't understand the quantitative techniques required to accurately measure it, you'd better find and work with someone who does, beyond the ability to simply parrot some vernacular and acronyms. Risk probability is measured as the degree to which something changes. In finance, we're concerned with changes in market value, what is referred to as price volatility. The greater the volatility or change in the price of an asset, the riskier it is said to be. It's worth noting that price and value can become disconnected. As Warren Buffett said, price is what you pay, value is what you get. But we'll touch on that a bit later. The study of computing probabilities is the purview of the mathematical branch statistics and probability theory. And herein lies the reason so few people understand risk. People tend to dislike math. The human brain evolved to make simple, quick, intuitive judgments that avoid obvious threats such as venomous snakes and ravenous pantheras. There was, and for many people to this day still is, little need for mathematics in survival. And if anything, the intellectual resources required to use it would have been a waste of precious energy. Unfortunately, in finance, risks are not so obvious and require a considered approach to effectively manage them. In fact, they are extremely complicated and require not only a keen qualitative understanding of an investment's associated business factors, but also correspondingly complex math to measure them in meaningful ways. It's worth emphasizing that computations alone are not enough. One of the most significant causes of the 2008 financial crisis was not the arithmetic, but a poor effort to identify the contributing variables to include in the calculations. It's arguable these factors were deliberately omitted to maintain the highly profitable game of musical chairs for as long as possible. But that's another story. So in lieu of math, when most people consider risk, they revert to an intuitive feeling that most often bears little resemblance to reality. A fairly common example of this phenomenon is the person who is afraid to fly on a commercial plane but has no problem speeding through traffic on a congested highway where the probability of fatality is demonstrably higher. A A significantly contributing factor to this misestimation is the fact that people tend to believe that their control over a situation reduces risk, when oftentimes, especially in financial matters, the converse is true. When it comes to investing, people's desire to reduce perceived risk through direct control is often expressed through real estate investing, despite the fact that they know little to nothing of investing or real estate. A glaringly ironic example of this paradox is the ultra-high net worth individuals who rely on a family office for comprehensive investment and financial services, except when it comes to real estate, where they invariably take a DIY approach. In the fairly rare instances when real estate investors begin to consider risk management, they tend to talk in operational heuristics. Reduce risk by buying the worst house in the best neighborhood. Use qualified professionals. Borrow on decent terms. While these quasi-solutions begin to address issues that each contribute to the probability of a negative outcome, they fall short, as was made painfully obvious by the colossal losses incurred by real estate investors in 2008. Just like pre-2008, lulled into a false sense of confidence by the bull market of the past decade, this round of DIY investors is not prepared for the next crisis that's likely to occur in the not-so-distant future. So write this down. Risk is a number. It's the probability of loss weighted by the potential degree of that loss. Risk is not a feeling, it's not a relationship, it's not a story. It's a number. And that number is calculated with a bit of fairly complicated mathematics referred to as risk-adjusted performance measures. But that's just it. Risk is something that can be measured, and the math behind it is just a complicated ruler that, when used properly, gives you an accurate measure of the quality of an investment or portfolio. Another way to think about this idea is to consider the risk measure of an investment to be the measure of its quality. While most everyone is quite accustomed to thinking about investment returns in terms of percentages, risk should also be thought of as a percentage. Remember, it's the probability of loss weighted by the potential degree of that loss. Looking at an investment's potential return without taking into account its offsetting measurable risk is like looking at the deposits in your checking account while ignoring the withdrawals. If you cannot measure the risk of investments, whether you're selling or you're buying, you're playing blind. And that's the big secret. The mathematics of risk that govern financial loss with investments are just a more complex version of what govern the workings of a casino. And the top brass of big financial firms use that complexity to hide their insidious schemes through their captured and indoctrinated sales staff. But don't take my word for it. Have a look at Greg Smith's book, Why I Left Goldman Sachs, which provides a candid look at the dynamics between the biggest financial firms and their clients. I particularly appreciate that he pointed out in his 60 Minutes interview with Anderson Cooper that the skills required to construct and analyze such complexity is the domain of physicists, mathematicians, and engineers. He didn't mention MBAs. Even the highly and rightly respected CFA designation does not confer sufficient mathematical skill. Now, I'm going to arm you with these risk engineering skills, the same skills that we use in our third-party risk analytics and investment banking services, so that you can beat the big financial firms at their own game. For those who still aren't convinced about the value of measuring risk and prefer to trust their feelings when it comes to making investment decisions, I thought it would be valuable to share Wall Street's perspective on the market dynamic between emotional and mathematically skilled investors, the odd lot theory, as popularized by the bond statistician Garfield Drew in his 1941 book, New Methods for Profit in the Stock Market. In the pursuit to buy low and sell high, Wall Street views investors in one of two general categories, the smart money and the dumb money. Individual investors are the dumb money. Smart money, hedge fund managers, private equity firms, etc., reliably outperforms the market. Dumb money, individual investors, the sort of people who casually watch CNBC for stock tips, generally fares poorly. Individual investors are considered such dumb money that many professional investors regard them as contrary indicators, the odd lot theory. The lemming-like masses get excited and overly optimistic when the market's about to top, and they tend to get fearful and overly pessimistic when the market's about to bottom. The result is that the smart money continues to get richer and the dumb money continues to get poorer, especially around financial crises. This is why it is important for everyone to have a basic understanding of risk. By the end of this masterclass, all of you are going to be the smart money, if you aren't already. How do you evaluate risk? After you peel away all the licenses, professional credentials, and job titles, the degree to which an investor can answer this question is the degree to which he can be considered smart money. The smart money is able to proactively manage risk, which ultimately allows it to maximize gains, limit losses, and inspire the confidence of others as responsible stewards of money. The business of investing is the business of buying risk-adjusted returns at a good price. That's worth re-emphasizing. The business of investing is not simply buying competitive expected returns from a respected brand. It's buying thoroughly measured risk-adjusted returns at a good price. And for risk-adjusted performance to be accurately measured, it has to take into account the effects of market crises. In other words, risk measures must encompass at least a complete market cycle worth of historical data. Otherwise, the extreme risk associated with financial crises goes unaccounted for. Granted, this analysis still won't tell you about the full effects and potentially greater crises than what we've already experienced in the past, but they will give you a pretty accurate measure of how robust an investment is, especially considering the scope and scale of 2008, from which we do have data for analysis purposes. Here's a sample of that data. During the 2008 financial crisis, the Dow Jones lost 54% of its value. The S&P 500 lost 57%, and the national housing market saw a 27% dip. Now, while the national average of actual losses in housing weren't quite as bad as it felt in absolute terms, they were devastating considering the fact that if you had a mortgage with an LTV in excess of 70%, which was almost everyone who had recently purchased a house at that time, you had lost your entire investment in that property, which accounted for a huge amount of most people's net worth, if not all of it. Unfortunately, when people actually do begin to think about risk in meaningful terms, they tend to do so with a filtered or short-term memory. Almost everyone, including the financial advisor crowd, sweep historical crises like that of 2008 under the rug as if it was an inevitable result that everyone lost big and that it was a one-time event. Financial crises would be bad enough if they were a once-in-a-lifetime event, but the reality is that they're not. Here's a timeline representing the financial crises we've experienced over the past 30 to 40 years. As you can see, they happen with some regularity, about once every 10 years, with a trend of ever-increasing magnitude, which means we're about due for another one, and the fundamentals of the economy have been pointing to that next big one for quite some time. This brief history doesn't even include the skyrocketing interest rate environment that arose from Nixon closing the gold window on August 15, 1971, which led to the prime rate rising from 5.25% in December of that year to an almost unbelievable 21.5% on December 19, 1980. Interest rates have been artificially suppressed by the Fed to hover around all-time lows for over a decade to mask the full effects of the 2008 crisis, which has forced the US dollar between a rock and a hard place. Without diving into a treatise on monetary policy, the takeaway story here is that there is no way for this to end well. With the Fed having no ammunition left in its arsenal and an entire economy dependent upon cheap money, 2008 will look like a blip on the radar. It's just a matter of when. So the multi-trillion-dollar question is, when will the next crisis occur, and what's the risk to you? The good news is that not everyone did lose in 2008, or 98, or 89. A handful of people made out hugely profitable, and some of those same people have continued to be so during the bull market since. Isn't this a club you'd like to join? An extreme example of the concept of mispriced risk is that of a lottery ticket. The potential return on a $1 investment, the purchase price, in the original Powerball yielded an average potential return of approximately $25 million. That's the estimated average of Powerball jackpot cash payouts, not paid as an annuity, or 2.5 billion%. But the risk of losing the total investment was approximately 99.999999943, 1 in 175 million chance of losing. This means that to make a $25 million Powerball cash payout a fairly priced investment, a ticket should have cost approximately 14 cents. That's $25 million divided by 175 million. The rest of that dollar, less operating expenses, became profit for the lottery corporation. The cash payout jackpot would have to have reached $175 million before a ticket became a fair bet. Keep in mind, these numbers don't take into account the risk of splitting the pot with another ticket holder, nor do they account for taxes. Again, the point of this example is to emphasize that a focus on potential return without adjusting for risk is a misguided approach to investing that leads most investors to overpay for assets. This example highlights the glaring fault in how almost everyone thinks about investing. People, including most financial advisors, focus on fairly specific numbers to vet potential returns. But when it comes to evaluating the associated risk, which is the most important aspect of investing, a decent story or sufficient immediate compensation is all it takes to consummate a trade. How can you possibly know if you're paying a fair price for an investment with this story-based approach to risk analysis? The answer is you can't. Who do you think benefits from you not knowing what you should be paying for your investments? I'll give you a hint. It's not you. Wouldn't you like to be able to flip that script? Not only is the probability of loss an important consideration to quantify in risk management, but even more importantly to consider is the potential degree of that loss. In other words, what's the cost of losing versus the reward of winning? The soldier's bad bet and tail risk. When evaluating risk, just as important as the probability of an outcome is the value of the positive outcome as compared to the value of the negative outcome. In mathematics, this idea is expressed as convexity, skewness, and kurtosis. The goal in finance and life in general is to make decisions that expose you to the greatest positive outcomes while risking very little. Many young people are drawn to the promise of income and a free education by the military in exchange for their service. While this may seem appealing as the positive outcome is guaranteed and the relative risk of being killed in action is low, the potential upside is limited to a few tens of thousands of dollars in monetary value, while the potential downside is catastrophic, being death. While it's a noble pursuit, from a risk management perspective, enlisting in the military is a very bad decision. In other words, the soldier's upside is finite, while his downside exposure is infinite. As a professional investor, you want to flip that dynamic. You want to pursue investments with infinite upside potential while being exposed to a finite downside, and preferably a very small finite downside potential. In the world of investing, what type of financial instruments create such an asymmetric or positively skewed risk-reward dynamic? I'll give you a hint. Options, and we'll talk about them shortly. But for now, suffice it to say that buying options creates positive convexity. Small potential loss with potentially infinite upside, and they can protect you from tail risk, which is described mathematically as kurtosis. I alluded to it a little earlier when I referenced the recent history of financial crises. In simple terms, tail risk describes very low probability outcomes that occur more often than expected. Technically speaking, it's the risk of outcomes greater than 3 standard deviations from the mean occurring as depicted by the normal distribution. For example, less than 0.3% of the time. The problems with tail risk are threefold. First, the normal distribution does not reflect reality, and tail risk tends to be fat-tailed, meaning that people have a short memory and dismiss events that occur about once every 10 years or more as things that effectively never happen. In other words, people have a natural tendency to grossly underestimate the frequency of low probability events. Secondly, tail risk events are based upon things that you don't know that you don't know. and are not accounted for in models that are solely predicated on past outcomes, which is another way of saying that the normal distribution is not an accurate model of reality. These unknown unknowns are what Nassim Taleb refers to as black swan events. The result is that most people get completely blindsided by tail risk, as was the case with the 2008 financial crisis. And third, as we just discovered, tail risks can be catastrophic. The most insidious way in which the big box financial firms manage their risk exposure, allowing them to profitably ignore their own risk analysis, is through regulatory capture, which results in socialization of the very risk they create. While many people look at the failures of the banks and the 2008 financial crisis as evidence of big investment bank incompetence, they are missing a critically important piece of the puzzle. The biggest investment banks are protected from loss by both the Federal Reserve, the Fed, and the federal government itself. While the mechanics of monetary policy are beyond the scope of this presentation, the bailout is fairly common knowledge. In short, the big banks know that if they make bad investments, they will be bailed out by the public. So their decisions are not based on ignorance, but rather a strategic understanding of their potential loss limits. Everyone should be aware of how the big investment banks exploit the population, and no text addresses this subject better than The Creature from Jekyll Island by G. Edward Griffin. It's a must-read to understand the American economic and political telenovela that is courtesy of the big financial interests. Another type of measurable risk is the loss of investment return due to inflation, or inflation risk. Arguably, the most poorly understood and insidious result of the banking cartel's influence over U.S. fiscal and monetary policy is inflation, or the loss of purchasing power of a currency due to an increase in its supply. For example, if you grow $100 into $103 over the course of a year, but items that cost $100 at the beginning of the year wind up costing $103 by the end of that year, your financial position has not really increased by the 3% it looks like. It stayed the same in real terms, as the increase in your amount of money is offset by an equivalent loss in its purchasing power. It's generally accepted within the finance industry that the current nominal yield of the 10-year Treasury note represents the risk-free rate of return. The problem, however, is that the risk-free rate, after subtracting the inflation rate, is effectively zero. In other words, inflation completely eliminates the real yield of U.S. Treasuries, and that doesn't even account for the fact that there actually is risk in holding U.S. bonds, as fiscal and foreign policies threaten the stability of the U.S. dollar. But we don't have time here to dive into those subjects. To make matters worse, the U.S. government's measure of inflation, the CPI, is generally manipulated to understate the actual rate of inflation, which makes the real yield of investments even lower, and in the case of the 10-year, negative. In other words, you're actually paying the government to hold your money. Peter Schiff of Euro-Pacific Capital once said he wished he could buy the CPI because of its eternally positive gains. Well, I'm going to show you how to effectively do just that. Now we're going to introduce the most well-known risk-adjusted performance measures of the religion that governs the financial services industry, modern portfolio theory. I know this slide is fairly dense, so it's okay if you don't follow the numbers, especially if you're a retail investor, but your financial advisor should be able to. The reality, however, is that you can pass all the FINRA exams, which are the licensing exams for financial professionals, without understanding these numbers. As a result, many financial advisors don't have the skills to properly measure the risk of an asset or portfolio, especially those who are not CFAs. The point here is to simply introduce the meaning of these calculations to you. And if you don't want to or unable to do the math, I'll provide you the means to use these measures without having to do the math in a bit. Building on the earlier work of Harry Markowitz, who developed the idea of beta around 1952, the capital asset pricing model was independently introduced by Jack Traynor, William Sharpe, who also developed the Sharpe ratio around the same time, John Lintner, and Jan Mawson between the years 1961 and 1966. Sharpe, Markowitz, Miller jointly received the 1990 Nobel Memorial Prize in Economics for this contribution. Michael Jensen took the next step in 1968 with his first use of alpha. The point of giving you the brief history is to highlight these metrics have been around for a long time. And while they have some limitations, they've been recognized by the Nobel Foundation. An understanding of the mechanics of these risk-adjusted performance measures has led us to create more robust risk measures that capture very important third and fourth order risk considerations, but we'll go over those in a bit. In finance, expected return is equal to the geometric mean of an asset or portfolio's historical returns. It's not a guess about the future or a pro forma. Risk is mathematically defined to be the measure of how much the price of an asset moves up and down, called volatility. Beta compares the volatility of an asset to the volatility of the market. A beta of 1 means that the asset moves exactly with the market. The market's usually defined to be the S&P 500. A beta of -1 means that the asset moves in exactly the opposite direction of the market. And a beta of 0 means that the movement of the price of the asset has no correlation to the movement in the price of the market. The capital asset pricing model is a statistical method used to measure volatility of an asset relative to the market and provides the fair risk-adjusted expected return as a percentage for an asset or portfolio given its risk characteristics. Alpha is the additional return generated by an asset above what is fair given by the CAPM. Alpha is equal to the expected return minus the risk-adjusted expected return. The Sharpe ratio is a simpler risk-adjusted performance measure that compares the total volatility of an asset to its expected return less the risk-free rate, usually defined as the 10-year Treasury, as I just mentioned. A Sharpe ratio greater than 1 is considered good, greater than 2 is very good, and above 3 is excellent. There are many other risk-adjusted performance measures, including the Trainer ratio, information ratio, R-squared, Modigliani measure, omega ratio, maximum drawdown, and return over maximum drawdown, or ROMAD, value at risk, Monte Carlo simulations, and others. We don't have time to go into the math for each of these here, nor do I expect you really want me to, but it's important to know they exist, and each describe a different facet of risk. Some of these metrics, however, are more informative than others. Are you still with me? Again, I know that all this could be a lot to digest, but you have permanent access to this slide in your workbook, and you can replay this masterclass to review the material as many times as you like. I expect that I buried you in enough math in the last slide, so here I'll provide you the qualitative definitions of some of the more important risk-adjusted performance measures. Liquidity adjusted expected return. It measures the break-even return of an investment given both its market risk and illiquidity, only used for private or restricted securities. Very important for analyzing alternatives and especially private issues, non-traded issues. Maximum drawdown. Measures an investment's maximum loss from its peak to its trough before a new peak is attained. The lower the number, the better. This effectively tells you what is the potential downside exposure of your investment. The Modigliani risk-adjusted performance measure, M2 or RAP. Derived from the Sharpe ratio, M2 measures the total risk-adjusted performance of an investment as a percentage. The higher the number, the better. The omega ratio measures the total positive returns over the total negative returns of an investment. The higher the number, the better. What's really nice about omega and unique about it is that it captures all 4 statistical moments in one measure: mean, variance, skewness, and kurtosis. R squared. It measures the percentage of an investment's movement that can be explained by the market. R squared of 0 is ideal for actively managed portfolios. The Sortino ratio. Identical to the Sharpe ratio, except that risk is defined to only be the negative deviation as opposed to the total deviation. Again, the higher the number, the better. It's worth noting that return over maximum drawdown, or ROMAD as the name implies, is simply expected return divided by maximum drawdown, or MDD. Although beta, CAPM, alpha, and Sharp are better known risk-adjusted performance measures, Modigliani, Omega, and MDD are arguably the most informative. As a matter of fact, those are the three metrics we rely on most. For the mathematicians and physicists here, I'll tell you why. MDD tells you what your potential downside is, which is a straightforward and fundamental thing to know. Modigliani captures both market and total risk as a second-order measure. And Omega captures all four statistical moments, as I mentioned: mean, variance, skewness, and kurtosis. As a matter of fact, the matrix I developed takes all three of these metrics into account and provides one comprehensive, user-friendly rating. And here it is, the immodestly named Summers Alternative Risk Rating, or SAR. As we just covered, there is a fairly large number of risk-adjusted performance metrics that each speak to a different facet of risk. I've distilled the most informative risk-adjusted performance metrics into a concise rating system. It takes into account all four statistical moments of both systematic and idiosyncratic risk, including total potential loss. The first index of the SAR matrix, rows A through C, represent functions of maximum drawdown. The second index, columns 1 through 3, represent functions of the Modigliani measure, omega ratio, and the asset or portfolio's expected return. So as you might be able to gather, A1 is the best rating, B2 is the break-even point, and C3 is the worst. I'm really proud of this matrix because it's the only rating ever created that captures all four statistical moments of risk with a single output, and it's not dependent upon selecting the correct benchmark. Now that I've introduced the basics of risk-adjusted performance measures, let's start applying them. And what better place to start than to address the age-old debate over which market is better, real estate or stocks? Finally, here's the answer. The real estate market is represented by the MSCI US REIT Index, and the stock market is represented by the S&P 500. The data measured here goes back to 2004, which was the first year of the MSCI US REIT Index. Note that the risk-free rate was taken as a snapshot of the 10-year T-note on January 15, 2019. Take a minute to sift through all the numbers and tell me which market is better, real estate or stocks, and why. For all intents and purposes, financial advisors define real estate as REITs and generally disdain it, especially private real estate operators trying to push their syndications. I get why. Like a REIT, most private real estate investors with any size are simply buying the market. And if you're going to buy a market, you might as well buy a liquid one with historically better performance. There are a few other good reasons why financial advisors dislike non-REIT real estate. First, they're licensed to sell, advise, and get paid on securities, not real estate. Secondly, real estate syndicators tend to have little to no concept of risk, even in qualitative terms. And third, real estate people are always trying to sell some inflated, overly optimistic guess about the future. Financial professionals make at least a token effort to look at past performance as an indicator of investment quality. Of those three, I'd have to say that real estate investors' general lack of interest in risk and sophistication are their death knell in terms of viability as a legitimate alternative recommendation by financial professionals to their clients. That being said, the baby is being thrown out with the bathwater. Going back to quantitative risk analysis, there are very few asset classes that provide the relative lack of volatility that residential income does, as we're about to see. Note that I didn't say anything about market values. I'm talking about the actual income itself, the NOI. As an aside, it's worth noting that due diligence firms who know real estate want to see a minimum 300 basis point spread between cap rate and average cost of debt as an indicator of the ability to perform. So we just looked at the risk characteristics of two markets, but now we're going to take a look at one example of how innovative and skilled asset management can navigate trends and inefficiencies within markets to generate superior risk-adjusted performance. The graph captured here provides a fairly simple and clear illustration of how math, properly applied to historical data, can tell you a lot of very valuable information about the future that otherwise you'd have no way of seeing. I pulled this graph from an early 2007 draft of my ABL business plan. The data represented here by the blue jagged curve is simply the median price of U.S. houses going back to 1963. I somehow needed to use this data to make a prediction about the future. As you can see, the blue line is not straight, but it's not a smooth upward sloping curve either. One of the skills I'd used quite a bit during my time in physics was figuring out what equation most accurately matched a given set of data. This is called interpolation. It's exactly the opposite of what you learned in high school algebra, where you were given a formula and asked to graph it. Here, I've got the graph, and I need to figure out the formula. That is what is represented in primitive form by the red line and the yellow curve. The red line represents the linear formula that most closely matches the data. Think y equals mx plus b. And the yellow line represents the parabolic formula. Think y equals ax squared plus bx plus c. You can easily see that this Occam's razor iteration of quantitative analysis tells me that market values were in a bubble and should fall somewhere between the yellow and red lines. I used this information to establish the maximum loan to value I was willing to lend through the ABL fund. So why is this important? Well, if the banking industry had performed this same very simple mathematical exercise to guide their mortgage underwriting, we would not have had a financial crisis in 2008. And as you can see by the actual data here that was updated through 2014, housing prices did indeed fall back down between where the yellow and red interpolations predicted. And it wound up falling much closer to the more conservative red line, which people back in 2007 told me could never happen. But beyond simply confirming the validity of trend identification, this particular data set begins to highlight the biggest advantage non-traded alternative assets have over their traditional publicly traded counterparts. The issue with sticking to traded assets is the secondary market itself. It is efficient, which leads to a virtual zero-sum risk-reward dynamic, and it can move quickly and dramatically. Private alternative asset markets are very different. This graph highlights the specific example we have been able to capitalize on, and in over 15 years, I've yet to see any other fundamental metric that provides the same systematic opportunity to generate risk-adjusted performance: residential rental income. As you can see, while comparable sales values represented here as the housing price index have obviously bubbled, the income itself, as represented by owner equivalent rent, glides along very similarly to the CPI. This relationship represents a profound opportunity for arbitrage that is lost on almost the entire real estate market. The irony here is that residential real estate, and by extension multifamily, investors are a dime a dozen. Yet almost all of them miss capitalizing on this dynamic. The tragedy and opportunity lies in the fact that they're all doing the same damn thing. From the biggest REITs to the smallest mom and pops. They tend to just buy at market value and hope for an eternally appreciating future. If you're acquiring real estate assets at market values or lending at market LTV, you are subject to effectively the same market risks as any other asset class. But if you structure investment vehicles that are valued as a fixed, disciplined multiple of the income itself as opposed to market cap rates, then you have effectively created an asset that is better insulated from market risk than anything else available. This can be achieved, as we did, by a de facto loan structure with a basis calculated as a fixed multiple of income as opposed to some arbitrary LTV. Further, various derivatives can be employed, such as swaps and options, to extract the stability of the income and potential upside without substantial downside exposure. To make matters even better, because the real estate market is an inefficient, unsophisticated private alternative asset class, especially on the small balance side, there are substantial holes that can create tremendous arbitrage opportunities that can be capitalized on by savvy asset managers, not only in terms of acquisition costs, but in terms of capital structure development and derivatives pricing. Nothing even close to this opportunity exists in the public capital markets. While investment models built on residential income represent the greatest opportunity to generate unparalleled risk-adjusted performance, there are many other private alternative asset classes that provide similar opportunities. They just tend to be a bit more complex and less prolific, but they're out there. To help inspire confidence in their strategies, regardless of asset class, private fund managers can, should, and often do utilize third-party administration, provide quarterly reporting, and annual audits. This should help offset financial advisors' false sense of security and the transparency of public equities at the expense of real risk-adjusted performance opportunities. If you only knew how fabricated these quarterly earnings reports really are, ask me how I know, or had any meaningful recollection to what extent that transparency protected them during the last financial crisis. All that being said, the first step in overcoming the grossly limiting false belief that all alternatives are inherently riskier than stocks, bonds, and mutual funds is for financial market participants to recognize this fact. Risk-reward is only a zero-sum game within efficient markets, the only markets financial advisors tend to be familiar with. The inefficiencies in information and capital flows that are intrinsic to private markets create extraordinary opportunities for disproportionate risk returns relative to risk. The second step is to begin thinking and communicating about risk in objective, quantitative terms. Now taking a look at the mechanics of how to capitalize on market inefficiencies, once you've identified a reliable trend or arbitrage opportunity, derivatives can be used to isolate and take advantage of it. A financial derivative is a contract that derives its value from the performance of an underlying asset. Basic derivative contracts include futures, forwards, swaps, and options. One of the most prolific and powerful financial derivatives is the option. There are two basic types of options: the call option or call, and the put option or put. A call option is what is utilized in the traditional lease option, which is familiar to most real estate professionals. The put, on the other hand, is virtually unheard of in the world of real estate. An option, a call or a put, can be used as a standalone contract or in various combinations simultaneously to bet on any potential outcome. In other words, option strategies can be structured to profit from an asset rising in value, falling in value, not changing in value, or simply by its value moving in any direction, up or down. Most importantly, options allow investors to create risk-return asymmetries or positive convexity, exposing them to infinite upside while incurring only a small, finite downside. While option strategies are considered basic knowledge for financial professionals, they are hardly understood by real estate market participants, and herein lies the opportunity. For example, no one in the small balanced real estate market has any idea how to price an option. Think about the opportunity that creates. We were able to take advantage of informational and capital flow inefficiencies in small balanced residential markets with our asset-based lending or ABL model. We utilized a leaseback with an option structure in lieu of traditional mortgages with valuations predicated on historical multiples of comparable rents to bet against comparable sales-based valuations. The result was that if our counterparty performed, we won. If our counterparty didn't perform, we won bigger. And the profitability of those trades had no dependence upon the phase of the market cycle. Tying together everything we've talked about so far, this is what the performance of our asset-based lending model looked like as evaluated in quantitative risk-adjusted terms. While many people, including most financial professionals, may require a bit of a learning curve to fully grasp the meaning of these numbers, the fundamental fact remains that audited quantitative measures of performance are the only meaningful criteria by which to evaluate the quality of any investment and, by extension, any portfolio. The Adagio ABL numbers above represent our residential income arbitrage fund, which was a private structured product designed to capture arbitrage opportunities between residential market values and actual income, while incurring less actual risk than any publicly traded asset. For those of you who do feel comfortable diving into the numbers at this juncture, if you look closely at them, you'll see that Adagio ABL's beta is calculated against the S&P 500, not the MSCI US REIT Index. I occasionally catch flack for this from the random pedantic CFA who ironically misses the arbitrary nature of a benchmark in general. The fact of the matter is that, first, REITs are highly correlated to the S&P, and two, when people evaluate investment performance, the S&P is invariably cited as the ruler, regardless of what is being invested in. I can't count the number of times professional money managers passed on our ABL fund after 2010 because of the perceived opportunity in the run-up of the S&P, while conveniently forgetting to compare 2008 performance. Ultimately, when you remove the veneer of Ivy League MBAs and the tenures at Goldman, the finance industry is a culture governed by herd mentality and arbitrary belief orchestrated by its power brokers to maintain the status quo. It's not too dissimilar from any given religion, sans the millennia of tradition. Market benchmarks are just one expression of these arbitrary beliefs, and the S&P 500 is the holy of holies. So now returning from my religious diatribe, when some alternative sponsors, such as hedge fund managers, attempt to use these measures, regardless of the index, they typically do so without really understanding the math. They typically only take into account a relatively short time period of performance data, assume the real world can be mathematically represented by the normal distribution, and ignore third and fourth order measures, skewness and kurtosis. This is why so many financial advisors have been fooled by good Sharpe ratios. Without a true understanding of the mathematics, the metrics are almost always misused and the output paints a grossly incomplete picture. All this contributes to financial advisors justifying to themselves why incorporating such metrics into their business is not worth the effort. There just aren't enough players using meaningful risk-adjusted performance measures to make them worth the time to master. That being said, if your asset management or investment business is actually better than what is otherwise available, and you want to successfully compete with the glut of mediocre traditional assets and advisors littered across the landscape, this is how you do it. You use the math properly to measure a minimum of one complete market cycle of audited performance data and communicate your performance in well-established quantitative terms. If you can do that, there is no reasonable argument anyone in the capital markets can make for not allocating to your asset management business. The only other meaningful variable we haven't touched on yet is liquidity, but that's a played-out excuse for not allocating to private alternatives that is grossly overused, especially in the case of private fixed income products and private equity for younger investors. But we'll address that a little bit later. To highlight the value and meaningful application of quantitative analysis to private alternative assets, Mark Rentz of Socius Family Office described it as a unique opportunity to effectively manage risk. Mark runs one of the best family offices, if not the best family office I've been around. He takes his fiduciary responsibility as serious as anyone. He has both the credentials of a CFA and the wisdom to translate his rare level of expertise into faithfully carrying out his fiduciary role without regard for the incessant corrupt forces of the industry to do otherwise. So in short, the skills of meaningful quantitative risk-adjusted performance analysis represent an absolute unique opportunity for private alternative asset managers to enter the high-stakes game of institutional finance, especially with those institutions who are motivated by merit. And institutional finance is where the real money changes hands. So due diligence officers, how much better will you be able to not only protect your firm, but support your reps with an accurate measure of the risk characteristics of the sponsors you vet and ultimately accept onto your platform? Translating the numbers into tangible examples, a byproduct of comprehensive quantitative risk analysis is that the process identifies which sponsors are able to execute their strategy and liquidation schedule without cutting distributions. How would that ability improve your value to the market and protect you from liability? Now you're probably thinking, most sponsors don't have a track record that encompasses a complete market cycle. That's true, but rigorously constructing a theoretical track record based upon all relevant actual historical market data is the solution. You first must translate their investment model into a comprehensive set of rules, then identify every variable reasonable that contributes to their performance based upon those rules. From there, it's just a matter of researching and plugging in the actual historical data into those variables. Don't get me wrong, it takes a thorough understanding of statistical mechanics to create a meaningful theoretical track record, but the value of having it far outweighs the cost. Third-party due diligence firms. How much more meaningful do your third-party due diligence reports become when you start quantitatively measuring the risk of sponsor offerings and providing an objective measure of their performance expectations. How much more valuable do you become, not only to the broker-dealer community, but to the RIA space by meeting their needs as an outsourced due diligence service provider? From a revenue perspective, how would your business model improve if instead of only being compensated on the front end of client engagements, you were able to establish an ongoing revenue stream measuring their risk-adjusted performance on an annual basis? Again, how would your position in the industry improve if you were able to provide an accurate estimate of the risk associated with any alternative? We already have an example of what this can do for a firm via traditional assets. Look at Morningstar. RIAs. How valuable would it be to your business if you could clearly and confidently identify quality, low-risk alternatives that meet your clients' objectives in ways not possible with any boilerplate allocation to public equities, bonds, and mutual funds? How would it help you grow your business and recruit new clients if you were able to measure and communicate the risk-adjusted performance of your portfolios? Approximately 14 out of 15 RIAs do not recommend alternatives because of their perception of risk, opacity, illiquidity, and E&O considerations. While most are indeed bad investments, the best alternatives provide far better uncorrelated and absolute risk-adjusted performance than any traditional asset. How would your business improve if you could confidently identify those gems? Family offices. How can you achieve capital preservation, especially across down cycles and market crises, if you haven't measured an asset's or an asset manager's sensitivity to the market across at least one previous complete market cycle? How do you know which asset managers are able to provide you the best opportunities for growth if you don't measure the risk that corresponds with that expected growth? Trendy investments do not equal sound investments, and AUM is not inversely proportional to risk. Researchers from Purdue and Loyola Marymount conducted a study to evaluate size, age, and the performance life cycle of hedge funds. They analyzed Lipper, TASS, and HFR monthly performance data ranging from January 1994 to December 2016, breaking it down into three groups: less than 10 million under management, small; 10 to 100 million, medium; and more than 100 million, large. The results, in short: the smaller the hedge fund, the more likely it is to outperform. As far as big funds are concerned, the younger they are, the better. This is just one more example of how the heuristics and beliefs that govern institutional investors' allocation decisions are often misleading. What other false beliefs do you have that might be adversely affecting your investment decisions? I'll give you a hint. The ability to acquire vast amounts of information from an ivory tower is not tantamount to effectively and objectively analyzing it. Sponsors and fund managers. How much more money would you be able to raise? How many more selling agreements, RIA, and qualified purchaser relationships if you were able to measure and communicate the merits of your investment model in meaningful, quantitative terms that allowed you to be compared apples to apples with any other investment product in the market, from Apple stock to an index of student housing REITs? For those newer sponsors that don't have a significant track record, or any track record for that matter, how valuable would it be for you to be able to construct a theoretical track record that was recognized and respected by the industry for the objectivity and rigor that went into creating it? To address the non-financial professionals here, you're not expected to be able to calculate the risk measurements of investments. The takeaway here is that risk is not a story, it's not a relationship, it's not a feeling. Risk is a number. It's the probability of loss weighted by the potential degree of that loss. If your financial advisor can't tell you the risk measures of an asset or portfolio, then you need a new financial advisor. Look, I know the vast majority of financial advisors are not great. Most broker-dealers are just looking to collect a commission on the next trade, and RIAs are too preoccupied with client recruitment and minimizing liability to create any uniquely valuable solutions for you. That being said, there really are a handful of very good financial professionals operating in the market, like those in attendance here, that are willing and able to provide far more value than what they take in fees. There's a large contingent of investors whose experience with financial advisors, stocks, bonds, and mutual funds has driven them to exit the markets and buy physical assets directly, most often real estate. They tend to think direct ownership of physical assets is tantamount to a risk guarantee. As we discussed earlier, the feeling of security afforded by the DIY approach is a mirage. The idea that a non-professional asset manager can navigate all the pitfalls of managing a portfolio of assets, not to mention the infinitely complex dynamics of the market, is a fool's errand. Deciding the appropriate leverage ratios, identifying the phase of the market cycle, accounting for the variability in rehabilitation costs and timeframes, planning for the effects of vacancy, tax considerations, the list goes on and on. But in short, control creates a blinding illusion that causes people to grossly neglect the risks they subject themselves to. Sure, some DIY investors may do well for a while when the market is heating up, but when the market comes back down, as we saw in 2008, the DIY crowd gets wrecked. Unless you plan to make asset management your career, you're best served spending that effort finding one of the few really good financial professionals already operating in the market. So to summarize and restate this extremely esoteric and invaluable secret, risk is a number. It's the probability of loss weighted by the potential degree of that loss. As with anything else, if you want to manage risk effectively, you first have to measure it. A successful application of this fact is quantitative risk-adjusted performance analysis as measured across a minimum of one complete market cycle and applied to private alternative assets, specifically relying on well-designed capital structure and derivatives with an inefficient market such as small balance residential income. Again, there are other private alternatives that provide the potential for similar risk-adjusted performance as underlying assets. You're probably thinking this is way too complicated for you to deal with, or that you're not good at math so you won't be able to develop these skills, right? Well, I've got a couple solutions that will take care of all the mathematics for you. We'll discuss them a little later if you'd like. So now that we've covered the first secrets that deal with how to generate, analyze, and report performance that is measurably good enough to responsibly offer as a competitive investment, we now have to create the means for others to participate or invest in our asset management business, which leads to secret number 2. By responsibly issuing your own private securities, you can raise tremendous amounts of capital, both as debt and equity. Meanwhile, you'll be providing retail investors the means they desperately seek to safely grow their savings and generate retirement income. This is where the rubber meets the road. As I think a lot of people already know, the 2008 financial crisis could and should have been much worse than it actually was. Decades of irresponsible U.S. fiscal and monetary policies had built up enormous imbalances in the economy that needed to be corrected to make sure that the resources of the economy were being utilized in the ways that maximize the efficiency of people's work and provides the highest standard of living for all. That correction was never allowed to take place. As soon as the first rapid, dramatic wave of economic correction hit Wall Street, both Congress and to a much greater extent the Federal Reserve injected trillions of freshly created dollars into the global banking system to stave off the imminent collapse. The result, while minimizing the immediate effects of the crash, has created even further fundamental economic instability, which has the world primed for an even bigger collapse. My research into this dynamic peaked around 2012 when the Fed was going all out with quantitative easing, which is just a sophisticated moniker for creating new money. Through that effort, I uncovered the most fundamental and profound levels of corruption you could imagine. Like I mentioned earlier, there's no better work on this subject than G. Edward Griffin's The Creature from Jekyll Island. The good news is that my research also revealed the fine points of how to use the mechanics of money creation for good. The ability to issue private securities is only one step removed from the process by which the Fed and commercial banking system create and multiply the money supply. The ability to create securities is literally the ability to create a form of money out of thin air. So you're probably thinking that of course people value the money and assets created by banks, but I'm not a bank, right? Well, not yet. But I've just showed you the esoteric risk engineering skills that the most sophisticated financial institutions use to give value to their products. Now I'm going to show you how to convert those skills into valuable, saleable assets that you can create out of thin air. When you create securities for sale that meet investors' demand for risk-adjusted returns and liquidity, the purchaser recognizes the value of the purchase price as part of their savings, and you have the equivalent amount of cash in your hand to operate your asset management business. When properly managed, both the value of the securities and the value of your asset management business grow in tandem. So by the time we're done here, you can be your own bank, if that's what you'd like to be. In the words of Sal Buscemi, you want to know why you're not rich? It's because you don't know how to raise private capital. Well, I'll take it one step further. You want to know why, even if you are rich, you're still subject to the whims of banks? It's because you don't know how to create valuable capital at scale. The ability to create better capital than what's available in the public markets solves both sides of the problem highlighted here. 1 in 3 Americans has $0 saved for retirement. And only 13% of Americans have at least $300,000 saved for retirement. It takes at least $2 million to retire comfortably, and over 20% of the U.S. population is comprised of baby boomers. So that means most don't even have anywhere close to where they need to retire, much less in comfort. One of the many bad results of this statistic is that even those who retire with a decent nest egg are forced to buy high-risk assets to achieve returns that are anywhere close to what they need to live on. The ability to create quality private capital allows you to convert exclusive, valuable know-how into money more quickly and at greater scale than what is afforded by any other business model, financial trick, or tip. You'll be able to create whatever value you want for yourself as retirement savings. In other words, if you don't see a way to save your way to retirement, the solution is to learn how to create the money you need for retirement, and anything else you'd like for that matter. In the process, you'll gain the ability to serve those who do have retirement savings better than the dysfunctional institutions they currently rely upon by providing them high returns with lower risk than they can get anywhere else. So now we begin to dive into the nitty-gritty of capital formation with a quick look at capital structure. Capital structure is the combination of debt and equity instruments used to finance assets, including businesses. In general, when these instruments are sold, they're called securities. When most people need money, they think in terms of borrowing. In capital markets terms, borrowing is an act of issuing or selling debt, or notes, which promise the purchaser a stream of fixed income. But debt, for example bonds, isn't the only type of financial instrument that can be issued. One obvious point I should make here is that securities laws are complex, and traditional bank borrowing represents an exception to the definition of securities issuance. But if you're borrowing from the public, especially in the form of fractionalized notes, you're almost certainly issuing debt securities. Equity, or ownership interests, for example stocks, can also be sold, which affords the buyer participation in an asset's profits. In overly simplistic terms, equity can be thought of as the down payment above the debt required to buy an asset. People are generally aware of public equities, or stocks, such as shares in Apple or Exxon, but private companies can also sell shares in their ownership to raise money. A common example is real estate syndication, interest sold over a crowdfunding site. The idea of capital structure is extremely important as the relationship between debt and equity not only profoundly affects the risk characteristics of your business, but it also goes a long way in determining the marketability of the securities you seek to issue. For example, if your business is exclusively financed by debt that obligates you to 15% annual interest payments and your business only generates 12% per year in profit, you'll bankrupt yourself solely by virtue of having a poorly constructed capital stack. On the flip side, if your business was entirely financed by equity, you'd be fine. The question becomes, what is the best ratio between debt, equity, and hybrids, such as convertible bonds and preferred equity, that maximizes profitability while minimizing risk? The answer is generally different for every business given its specific characteristics, and having the ability to determine that answer is arguably half the battle in creating quality private capital. Who here has ever run into trouble building the capital structure for their business or real estate acquisitions? One common example that comes to mind is simply the percentage down payment required for a real estate acquisition by a mortgage lender as a condition for writing the loan. In this case, the borrower is relying on the bank to determine the capital structure for them, and oftentimes the terms of the down payment and debt can kill a deal. When you're able to issue your own securities, you reap both the responsibility and the benefits of determining your business's capital structure. Instead of the bank offering its savings account and CD depositors around 1% on their money to turn around and lend it to you at 6 plus, if your business is sufficiently structured, you can cut out the middleman and offer would-be bank depositors 5 to 10 times what they'd otherwise get in their money without exposing them to additional risk while getting the capital you need on your terms. To sell the securities you create, it's critically important that you understand the markets in which they are bought and sold. Keeping abreast of what's happening in the capital markets will tell you what types of financial products and what performance standards are in demand. This information should help guide you in the development of your capital structure. So what exactly are capital markets? Capital markets are the result of demand and supply where securities that are held for a minimum of 1 year are bought and sold, generally through intermediaries called broker-dealers. Markets include mechanisms to determine the price of traded assets, communicate price information, facilitate transactions, and effect distribution. As a result of the Fed's monetary policy, there is approximately $20 trillion held in savings by U.S. workers that are in demand of decent low-risk, real yield that is unmet by traditional financial assets. This creates a tremendous opportunity for private securities issuers to meet that demand. So that's what you must strive to do. Create better financial products on both a risk and liquidity adjusted basis than what's otherwise available and bring them to the capital markets so you can outcompete the likes of Apple stock, U.S. Treasuries, and the litany of mutual funds being peddled by know-nothing sales guys. It's worth noting that there are alternatives to broker-dealers in facilitating capital markets, but you have to be extremely diligent about not violating securities laws when utilizing these other means. Have you ever tried to raise money outside of the confines of bank borrowing or broker-dealer platforms? For example, syndicating real estate deals to your high net worth Rolodex? What was that experience? What were the challenges you faced? I've worked with quite a few clients who've done so, and every one of them who was raising money at scale was unwittingly breaking some securities law or regulation. And more often than not, they had a hard time staying solvent as they grew without continuous corralling. But we'll go a little more into that later. Anyway, that's the goal. To structure your business in a way that makes you a demonstrably responsible steward of other people's money and to scale through the capital markets by creating better financial products. That's the name of the game, as opposed to, hey neighbor doctor, will you give me $100,000 for my syndication? As most people are aware, financial advisors, whether broker-dealer reps, registered investment advisors, or hybrids, are the gatekeepers to the public for the financial services industry. So to maximize the potential for any securities offering, public or private, to fully reach the retail market, financial advisors need to be recruited into the distribution effort. But thanks to a history of incompetent and irresponsible private asset managers pushing deals that ultimately didn't perform, this can be more difficult than it sometimes should be for the few alternative asset managers and sponsors that are able to deliver superior performance. Most financial advisors adhere to a very traditional asset allocation model built entirely upon public securities. Outside of the fact that a set of relatively vague, qualitative criteria govern the literal value of their client's life's work, the substance upon which these models are predicated is a set of assets completely dependent upon schizophrenic secondary markets. What's more remarkable is that the gross limitations of what effectively boils down to the sales function for a pump and dump business model are on full display in the FINRA texts, albeit in polished vernacular as a de facto disclaimer. Market value is undiversifiable. To give you an idea about what you're competing with in the capital markets from a performance perspective, here's a sample of traditional portfolios made up of publicly traded stocks, bonds, mutual funds, and money market instruments. The vast majority of financial advisors are driven by regulatory and revenue considerations to take a very generic, cookie-cutter approach to portfolio construction that includes just a few basic options. This is about as good as it gets when you go to your financial advisor and have him construct an investment portfolio for you based upon your individual appetite and growth needs. Just pick a box. So you've got the conservative portfolio, the balanced portfolio, the growth portfolio, and the aggressive portfolio. As you can see, the conservative portfolio lost almost 20% in its most down year. How can that possibly be deemed anything close to safe in any terms? Aggressive growth averages sub 10%. You can lend on conservatively valued real estate with a 35% equity cushion and do better than that, without taking a big hit in the down years. No matter how you slice it, the results of traditional portfolio construction are not awesome, and that's due in no small part to the way in which financial advisors are paid. Broker-dealers simply collect commission on the sale of financial products, and registered investment advisors, or RIAs, get paid as a percentage of their total assets under management via the recruitment of high net worth clients. In neither case are financial advisors incentivized by the merits of their advice. As a matter of fact, they are very much disincentivized by regulatory risk to do anything other than construct portfolios that conform to this very uninspiring structure. To make matters worse, between broker-dealers and RIAs, only RIAs have a fiduciary obligation to act in your best interests, and even that does not equate to making a rigorous effort to assemble the best portfolio and investments possible. Many RIA firms delegate the actual construction of investment portfolios to what's called a turnkey asset management platform, or TAMP. You can imagine how valued the investment decision-making process is when it's delegated to a third party, and the results follow as you might expect. If you can demonstrate organizational integrity, transparency, and performance that substantially exceeds this fairly low bar and addresses the regulatory concerns of financial advisors, what kind of opportunities do you think might exist for you to capture a piece of the tens of trillions of dollars in investable assets starved for low risk, fixed income, and quality risk-adjusted growth? For those of you who are financial advisors that recognize the shortcomings of the industry, wouldn't it be great to be able to provide your clients products that are demonstrably better than what your competitors are able to offer? Private investment companies. Shares of equity in private businesses are not available for public purchase, as is the stock of a publicly traded company such as Apple. In general, publicly traded companies must register with the SEC under the Securities Act of 1933. Investment companies must also register under the Investment Company Act of 1940. A major type of company not covered under the Investment Company Act is the private investment company, which is simply a private company that makes investments but is exempt from registration with the SEC under Regulation D of the 33 Act and Section 3C of the Investment Company Act of 1940. There are a few different types of private investment companies, and they all fall under the category of alternative assets: hedge funds, private equity, and venture capital. In defense of the financial advisor community, and as many here will attest, private or Reg D funds have a pretty bad reputation in general. Many are poorly managed and don't execute their exit strategy. That being said, as we discussed in the first section, the opportunity to generate substantial risk-adjusted performance can only be accomplished in the private fund space. So how do we overcome financial advisors' perception about private offerings to give the quality private funds and sponsors that do exist an opportunity to be fairly evaluated by traditional financial distribution channels? Private fund sponsors have to put themselves in the shoes of the due diligence officers and financial advisors who are risking their business by offering their private fund. Financial advisors are burdened by extraordinary regulatory constraint and potential legal liability that can result in the loss of a highly valuable client or even their entire practice if they recommend a bad private investment. This potentially catastrophic outcome is enough to close most financial advisors off to the Reg D space. Publicly traded assets are at least ostensibly transparent, as mandated by the SEC's registration process. Private funds are not subject to the same rigors and transparency mandates, which makes broker-dealers and RIAs particularly nervous about private offerings. As a matter of fact, the biggest objection financial advisors will typically cite for not recommending private funds to their clients is lack of transparency. But this is something that can be fairly easily rectified. Use a third-party fund administrator, issue quarterly financial reports, and have your fund audited annually by a nationally recognized accounting firm. This gives private fund managers effectively equivalent transparency as their publicly traded counterparts with their 10Qs and Ks. Further, communicate in your two-pager and deck how your fund and capital structure are designed to match the liquidity and risk characteristics of the underlying assets, and have a due diligence report issued by a reputable third-party firm to inspire confidence in your operational infrastructure and to verify the claims you make in your marketing and offering documents. Another big objection financial advisors have about private funds is their lack of liquidity. It is true that this is a constraint that regulations make impossible to completely eliminate, but private fund managers should make every effort to minimize the duration of their lockup period. One means of accomplishing this is by utilizing an interval fund structure, which is based upon maintaining a fairly large portion of the fund's portfolio in relatively liquid assets to average down the necessary lockup period as dictated by the most illiquid assets in the portfolio. Of course, great care must be given to this type of fund portfolio construction, as the liquid assets could dramatically affect both the risk and return characteristics of the fund. On the flip side, I'll remind the financial advisors here that you're well aware that FINRA expects you to advise any clients with near-term liquidity needs, as in less than a year or so, to be allocated in money markets. So if you're advising your clients on capital markets allocations, insofar as the lockup period of a quality private fund does not conflict with their longer-term liquidity constraints, the allocation decision should be based upon quantitative risk-adjusted performance measures. Of course, private securities that lack liquidity should pay a liquidity premium. But what should that be? It just so happens that Aswath Damodaran, professor of finance at the Stern School of Business at NYU, is well versed in private company valuations and illiquidity premiums. He cites the research on the subject to reveal that after all the noise is cleared, in general, the fair illiquidity premium of a private company relative to its public counterpart is less than 10%, while the remaining 20 to 25% discount commonly seen is purely a function of poor management. Think mom and pop restaurants. For professionally managed private companies and institutional grade private funds, an 11.1% illiquidity premium on expected return is very fair. Another way of illustrating this point is that the S&P 500 has generated an average of 7.77% over the last 14 years. If all 500 companies simultaneously go private tomorrow, they would lose approximately 10% of their fundamental value, yielding a liquidity-adjusted expected return of 8.63%, a mere 86 basis point difference. Private fund sponsors should be clear about the illiquidity premium associated with their fund in addition to its risk-adjusted performance characteristics as measured across a minimum of one complete market cycle and be fully prepared to communicate it. Hedge funds. A hedge fund is a common example of a private investment company. Hedge funds are actively managed in an effort to reduce or hedge risk, but the term has come to be used fairly loosely to describe many different types of investment approaches. Assets of the investment strategy are purchased or executed by a business entity, LLC, or more commonly an LP, the fund, that is managed by a second entity, an LLC or an LP, the management firm. The management firm is generally compensated on what is called a 2 and 20 structure, meaning that the management firm takes 2% of the total assets under management, or AUM, known as the management fee, in addition to 20% of the investment gains at the end of each fiscal year, known as the performance fee. Those percentages can vary from firm to firm. The management fee allows the management firm to cover overhead expenses such as salaries, legal, compliance, accounting, reporting, office space, etc., while the performance fee incentivizes the management firm to generate superior returns. In terms of private alternative assets, true hedge funds, by definition, are the only asset class that predicate their investment models on quantitative risk metrics. The problem with hedge funds is that few, and I mean very few, generate true portable alpha, and most have fared very poorly in their attempt to bet against the Fed since the 2008 financial crisis. Of the few that have done well, most have only done so of late and simply report quantitative performance over relatively short time periods, for example, less than one complete market cycle, at daily intervals, and just expect investors to take a flyer on very fat tail market risk. As a result, the financial advisors who do have some awareness of quantitative analysis dismiss the risk-adjusted reporting of these hedge funds as largely meaningless. and rightfully so. Further, when the finance industry thinks about hedge funds, it doesn't tend to think of them in the general sense. Financial firms tend to look to fit any self-described hedge fund into one of the following boxes. Long-short funds, which includes market-neutral funds or convertible arbitrage funds. Event-driven funds, macro funds, distressed securities funds, emerging market funds, long funds, short funds, fixed income arbitrage funds, merger arbitrage funds. So if you engineer a strategy that does a great job of hedging risk, but it doesn't fit into one of these 9 boxes, financial distribution firms will have a hard time understanding it and will typically pass. This is why we categorize the funds we create as structured products. The industry still has an expectation that structured products are a fairly specific thing, fixed income instruments created by layering options over an index. But there is a bit more willingness to accept the structure might not strictly conform to the familiar. Further, as I mentioned earlier, hedge funds have established a bit of a bad reputation since 2008, as many have bet against the Fed since then and lost. So, what about those of you who don't have an investment strategy or an asset management business of your own? Well, if you have relationships with high net worth individuals and or the marketing wherewithal to aggregate such, you can establish your business as a capital provider for other quality asset managers as a fund of funds. For those whose skills and resources are oriented towards marketing, relationship building, sales, and ultimately capital aggregation, a fund of funds can be a perfect solution. Fund of funds are managed by those who don't have an investment model of their own, but who can aggregate capital and access other well-managed funds that do. The process of setting up and running a fund of funds is almost identical to the process of establishing a fund to capitalize your own asset management business. The primary difference is that instead of sourcing and managing individual assets, your efforts are focused on sourcing other asset managers who are able to achieve competitive risk-adjusted performance. A fund of funds, or feeder fund, can be a great solution for financial advisors as well. A significant challenge associated with 3C1 and 3C7 funds under the 40 Act are the relatively high minimums as dictated by the 100 investor cap and qualified purchaser status mandate, respectively. Given the industry heuristic dictating that only 10 to 15% of a portfolio should be allocated to alternatives, and that quality private funds typically have minimums in excess of $1 million, such funds become out of reach for most retail investors. A $1 million minimum for a single private fund would require the investor to have approximately $10 million of investable assets, and this wouldn't allow for any diversification of the alternatives portfolio. This results in the need for individual investors to have around $100 million of investable assets to construct a diversified alternatives portfolio of quality private funds. This problem can be greatly mitigated by a feeder fund structure. The financial advisor establishes a single private fund that holds all his clients' alternatives allocations. That feeder fund, which now holds approximately 10% of all his clients' capital in aggregate, can then use this larger, concentrated pool of capital to allocate across a number of quality private alternatives and generate additional, well-deserved fees for the advisor in the process. For those of you who are not financial advisors but have an established high net worth network, wouldn't it be great to be able to compliantly provide them better financial products than what they can find anywhere else and profit handsomely in the process? This is almost certainly a much more lucrative way of both serving and monetizing your relationships than any other service or product you could possibly provide. The quickest and least expensive way for real estate asset managers in particular, who have saturated their friends and family network to quickly scale their business, is by securitizing their portfolio of stabilized assets under a series of Delaware Statutory Trusts, or DSTs. DSTs are trusts established under the laws of the state of Delaware and may confer an undivided interest in a common piece of real property to more than 35 investors, which qualifies under Section 1031 as a tax-deferred exchange. DST ownership essentially offers the same benefits and risks that an investor would receive as a single large-scale investment property owner, but without the management responsibility. In 2004, the IRS blessed DSTs with an official revenue ruling affording the specific structure like-kind status for the purpose of replacement property under a 1031 exchange. The revenue ruling permits the DST to own 100% of the fee simple interest in the underlying real estate and may allow up to 100 investors, sometimes more, to participate as beneficial owners of the property. DSTs are a product of necessity driven by investors' needs to roll over 1031 proceeds and are best suited for distribution through the independent broker-dealer space. In 2018, over $2 billion was raised across 35 sponsors with an approximate $20 million average equity offering per DST. A sponsor's first DST will typically require 6 months to complete the capital raise after all documents are drafted and administration established. The second, 3 to 5 months, and each DST thereafter typically requires 2 to 4 months to fully fund. Because DSTs are a product of necessity and carry relatively low idiosyncratic risk, the broker-dealer community is keen to host them on their platform, which makes them a great vehicle for real estate asset managers to quickly scale their investment business. Let's start diving into the specifics of private fund creation and securities issuance. Once you establish your investment model and determine your capital structure, you'll need to have the offering and marketing documents drafted to communicate the details in both legal and user-friendly terms. These documents consist of offering documents, which includes the private placement memorandum or PPM, also called the offering memorandum. This discloses the risk considerations, describes the management firm, compensation, investment approach, and the offering. The operating agreement for the fund itself details the structure and terms of the fund, as you might expect. The subscription agreement is the contract for the purchase and sales of the shares in the fund. The marketing materials are generally comprised of a summary, which is often called the two-pager, a sell sheet, a fact card, and the presentation or slide deck. Now, a few legal compliance considerations with respect to the 33 Act. While there are legal exceptions, such as crowdfunding, private securities should not be advertised to the general public, and investors should be accredited as defined by the SEC to mean they have a net worth of at least $1 million, not including their primary residence, and or make at least $250,000 per year as an individual or $350,000 per year as a married couple. The management firm must file Form D, a notice of exempt offering of securities, with the SEC upon selling any shares in its fund. If the fund invests in securities, the management firm may be required to register as an investment advisor. As I mentioned earlier, the 33 Act and Reg D are not the only legal constraints on private funds. Funds exempt from registration under 3C1 of the 40 Act are capped at 100 investors, including the manager. The 3C5C exemption allows for real estate funds only, and under 3C7, all investors must be qualified purchasers, which means in general they must have $5 million of investable assets or more as an individual, or $25 million as an entity. In addition to the offering and marketing documents we just went over, if you're pursuing distribution through broker-dealers and RIAs, you'll also likely need a third-party due diligence report, an internally produced due diligence questionnaire, or DDQ, and a Committee on Uniform Security Identification Procedures, or CUSIP number. So far, we've established that you have to first be able to generate, measure, and report quality risk-adjusted performance, and then package that performance under a well-designed capital structure to create a quality investment product. The third piece of the puzzle is to establish the operational rigor required to be considered a responsible steward of other people's money by the gatekeepers of the capital markets. At least one, but usually all three of these considerations are lacking in the potential clients we come across, regardless of the amount of experience they have. So let's take a look at the two general types of client profiles we encounter. One, the seasoned syndicator, and 2, the newbie. Each group always has the same objections out of the gate. The newbies don't think they're ready for this level of sophistication, and the seasoned investors are like, I've been doing this for a long time. I don't need help. The truth of the matter is, you all do. Not necessarily all of you, but yes, all of you. Here are the typical issues we see for each group. Seasoned syndicators are typically limited by an appetite for real estate. They rely on personal relationships. They may utilize crowdfunding. They typically overpay for money. Usually they unwittingly break the law in raising money, and they're typically unwittingly over-leveraged and hampered by debt service. One of our first clients had been in business for over 15 years and raised over $100 million. It wasn't until year 13 that they were informed of their illegal issuance of debt securities by a few individual states and the SEC, which compounded their existing problem of being insolvent. They didn't realize they were carrying too much expensive debt until a couple of deals out of the hundreds they had done didn't go as planned. So the moral of the story is that real estate experience does not equal competence within the complex game of managing other people's money. Now on the newbie side, they tend to think only in terms of debt, and they're subject to lenders. They typically overpay for money, and they struggle to capture quality deal flow, losing out to the established, deeper-pocketed veterans without readily accessible capital. The truth of the matter is that it's far less expensive to start out doing things the right way than it is to make costly and potentially career-ending mistakes by doing things poorly. The best case scenario is that you survive the early stages of growth, only have to completely restructure your entire business when you decide you want to gain serious scale, if you even make it that far. Those just starting out in the asset management business, and that includes anyone from active real estate investors to hedge fund managers, can find it nigh impossible to overcome all the hurdles that stand between developing an initial investment model and scaling it into a legitimate financial institution with hundreds of millions of dollars in assets under management. But Adagio's business is to ensure our client asset managers do just that. Think about that for a moment. Imagine what it would be like when you no longer have to submit to anyone else for money. When you not only control vast amounts of capital, but you have earned a genuine sense of pride in knowing that through the process, you have become a 1 in a million expert on money and business that can go toe-to-toe with the very top of the financial services industry. Isn't that something worth pursuing? Here's what the first steps of that path look like. We position our clients to raise equity capital without giving up control and low-cost debt on their terms. To accomplish that, we work with them to rigorously construct a theoretical track record that allows for meaningful back-tested performance. In other words, if they don't have a portfolio directly managed under a specific investment model, we ethically and compliantly allow them to show what it would have looked like if they had. The lessons they learn along the way enable them to outcompete well-established market participants with capital on demand, better structure, and portfolio construction skills. While it may sound complex, the learning curve isn't much steeper than what it takes to learn how to evaluate good real estate deals or various equities trading strategies. We take the securities issuance and regulatory requirements off their plate, which is far and away the most difficult part of the process. For the veterans who've been raising money for some time and are seen as the gurus of their real estate circles, as you're probably aware, there are much higher levels to achieve. The goal, as far as we're concerned, is to not be the lord of your fiefdom. It's to compete with the likes of Blackstone. Raising money for real estate deals and individual projects is one thing. It's something entirely different to manage a portfolio that is not dependent upon institutional debt and can be securitized to compete with the best financial products in the market. Our clients have consistently raised between $5 and $30 million per month by selling financial performance retail investors were unable to acquire through traditional channels, and they still have a tremendous amount of room for improvement. This is what the process of being our client looks like. We optimize their risk-adjusted performance through revising their investment model, operations, and capital structure, utilizing derivatives as appropriate. Then we create the distribution channels that provide our clients both direct and indirect access to the entire retail capital markets. which represents about $20 trillion starved for low-risk fixed income yield and quality risk-adjusted growth. It's like selling water in the desert. We structure their asset management business as an institutional-grade fund or structured product to meet the different types of retail investor demand. Some people, like retirees, need fixed income. Others need growth. We work with our clients to create better versions of both. So in short, we graduate our clients from raising money to distributing strategically designed financial assets through us. Isn't that level of institutional respect and scale something you've aspired to? It's our job to make it your reality, and that's what we do. So this is Joe Maiulo, a vice president of middle markets at Morgan Stanley in New York. When asked about Adagio's method of financial product development and distribution, he described it as an innovative solution to form debt and equity capital for private alternative asset managers who previously had no legitimate way to access the capital markets. Morgan Stanley is one of the biggest and most highly regarded investment banks in the world, and I think this comment captures everything that needs to be said. The quickest way to grow assets is by creating them. You're probably thinking, that's great, but it sounds way too complicated, right? Well, if you had to go out and hunt for the hidden information you need and figured out how to do all this on your own, it would be, but you don't. I've shown you exactly what you need, but if you feel you still need more guidance, we still have one more section to cover. Secret number 3. Here's one example that really captures the hidden but dramatic time bomb created by confidence in ignorance developed through what looks like long-term success. Woodbridge was one of the biggest private real estate investors in the country that had grown to manage over $1 billion in assets. The problem was that they unwittingly built their entire business on illegal securities issuance and a probably well-intentioned but irresponsible capital structure that ultimately turned into a Ponzi scheme and bankrupted them at the peak of the market. We reached out to Woodbridge several times to help right their ship in the years before all this went down, but they didn't think they needed us at the time we could have been effective. We were provided legal opinions by reputable law firms that defended their securities issuance practices. By the time they were willing to listen, it was too late. The SEC had already cornered them. One of the many takeaways here is that while there are a fair number of law firms out there claiming to do private securities work, only very few are truly competent in that arena. Unfortunately, this is not an isolated incident. There are several other firms we're aware of that have either already arrived at or are en route to the exact same outcome along an almost identical path. And just like Woodbridge, a combination of confidence and ignorance and too much inertia in the wrong direction prevent them from heeding good advice. I'm tired of hearing, I've been successfully doing this for a long time, I'm safe. No, you're not. Whether or not you're following the law dictates whether you're safe. The fact that you've been unwittingly getting away with breaking the law for a long time is simply not evidence of a well-run business. Now you can only imagine what kind of laws are being broken and financial best practices are being violated by the small startups trying to raise money. It's tough, I get it, but you have to do things the right way. Otherwise, sooner or later, things will end badly. To become financially independent, you have no choice but to raise capital from others. There really isn't any other way. You just better make sure you know what you're doing and you have the right counsel in place. The consequences are too dire if you don't. Don't let what you don't know that you don't know cause you the same avoidable fate experienced by the likes of Woodbridge. So we've established that securities laws are extremely complex and even vague. Here's a brief list of some commonly ignored securities law considerations that expose a lot of unwitting issuers to tremendous legal risk. First, debt instruments, such as private mortgage loans, used for the purpose of generating investment income, are securities. In other words, if you're borrowing money for your investment business from an entity that's not FDIC insured, you're likely issuing securities and subject to securities laws. You are not allowed to promise any particular return, as in implying no risk in your marketing. That is considered fraud. When you issue private securities, you have to file Form D with the SEC. Real estate itself can be defined as a security, and if you manage a real estate fund, you may be required to register with the SEC as an investment advisor. Syndicators issuing securities under the Reg D 506C exemption, that's crowdfunding, must verify the accredited status of every purchaser, and non-real estate funds with an incentive allocation, also called a promote or performance fee, can only accept up to 100 qualified clients, or all must be qualified purchasers. If you've ever been cited for behavior as listed under Rules 506D that defines a bad actor, you are prohibited from issuing private securities. If you knowingly break securities laws, you can go to jail. And most attorneys have different interpretations of securities laws. Here are a few considerations that can help broker-dealers, RIAs, and family offices mitigate their liability while better serving their clients. First, as we've talked about, measuring the risk-adjusted performance of alternative assets across a minimum of one complete market cycle can be the most effective way to not only serve your clients, but to keep lawsuits and the regulators at bay. Feeder funds or feeder entities can be utilized to compliantly provide clients diversified access to quality alternatives that have otherwise prohibitive minimum investment thresholds. Third, FINRA has stated that there is an inherent conflict of interest in having sponsors pay for third-party due diligence reports, which exposes most broker-dealers to potential regulatory risk. Consider joining or forming a consortium to share the costs associated with third-party due diligence reports required on alternative sponsors that includes quantitative risk measures across a minimum of one complete market cycle. As we've already begun to see, regardless of the merit of the offering, it can be surprisingly difficult to sell quality private securities through traditional financial distribution channels, broker-dealers, and RIAs. Why is it so difficult? Well, broker-dealers are typically motivated by regulatory fear that is only exacerbated by most alternatives and their transaction-based fees that often break the economics of alternative offerings. And retail advisors are indoctrinated to dismiss private securities due to their perceived lack of transparency and liquidity. They're also inundated with wholesalers pushing shoddy product on them all day long. That being said, it's worth noting that there's been an interesting trend over the past couple of decades. The number of publicly traded companies has been cut in half as regulatory pressure and market drivers have pushed more and more of the capital markets into private equity. To be fair, the regulators are squeezing all sides of the market, not just private issuers. The good news is that there's a compliant alternative means for private securities issuers to bypass traditional financial distribution channels to access retail investors, responsibly administered investment clubs. And they can benefit securities issuers, unlicensed relationship builders who want to both help and monetize their network, and retail investors alike. But before I dive into all the benefits, there are a few misconceptions about investment clubs that I should get out of the way. 1, investment clubs cannot advertise for new membership. 2, investment clubs cannot hold over $25 million in assets. And number 3, investment clubs cannot have over 100 members. These false beliefs generally come from a casual reading of the SEC's publication, Investment Clubs and the SEC, and may only be true if the investment club's membership interests are structured as securities, which effectively turns the club into a fund and makes it subject to the 40 Act. We make sure the clubs we work with are clearly not operating as private funds, which removes these constraints. Investment clubs, as recognized by the SEC, can be organized by anyone, no licensing required, and facilitate access to top-performing private securities for both accredited and non-accredited investors. You can profit by utilizing them to compliantly aggregate other retail investors to invest in quality private funds and afford yourself access to these funds in the process. So let's look at the legal basis. First, under the Investment Advisors Act of 1940, Section 202A11, teachers are specifically excluded from the definition of investment advisor. This exclusion allows for general financial advice to be provided by unlicensed individuals insofar as it is incidental to an educational program. So educational programs can be utilized to both market club membership and provide ongoing value to members in support of their shared interest to recognize appropriate quality financial products, which ultimately guides the club's investment decisions. Secondly, under the Securities Act of 1933, Section 230, Reg D, Rule 501A3, any business with total assets in excess of $5 million not formed for the purpose of acquiring a specific security is defined to be an accredited investor. In other words, the investment clubs themselves become accredited investors when they aggregate $5 million or more. And when they hit $25 million of investable assets, they become qualified purchasers. As long as no more than 40% of the club's assets are allocated to one particular fund, it is clear of being deemed as formed for the purpose of investing in any one fund. Why is the 40% threshold important? If the club were deemed to be formed for the purpose of investing in any given fund, the regulators will look through the club to evaluate the status of its individual members and potentially force the fund to register with the SEC, which could be catastrophic for the fund. Third, the SEC, in its publication Investment Clubs and the SEC, published January 13th, 2016, has specifically verified that membership in investment clubs is not a securities interest insofar as all members are active by vote in the decisions of the club. One of the biggest advantages of utilizing the investment club structure deals with advertising. Because club membership, when properly structured and administered, is not considered a security, there is no federal prohibition on general solicitation or advertising for membership. That allows for innovative marketing strategies to communicate the unique benefits of membership and aggregate AUM. Strategies that we've studied extensively, continue to utilize, and have proven highly successful. That being said, it is important to note that there are some state-level regulations that you must make yourself aware of to compliantly form an investment club in your area. Investment clubs afford financial advisors, independent insurance agents, IRA custodians, accountants, realtors, and other marketing professionals the opportunity to compliantly provide their clients, accredited, qualified, or otherwise, exclusive access to superior investment products and profit in the process. The ability to offer this service gives you a competitive advantage that can be compliantly integrated into your overall marketing and client recruitment efforts. Can you see the advantages of being able to pool unlimited money into accredited and qualified entities without being subject to the legal burden of managing a fund or securities brokerage? So here we are, shadow banking secret number 3. When it comes to compliance, what you don't know can hurt you, and badly. While maintaining competent compliance counsel is critical, the most powerful compliance and growth tool at your disposal is the motivation to do the right thing simply because it's the right thing to do. As a byproduct of applying this maxim, continuous improvement and growth will inevitably follow. So the shadow banking secret to keep you compliant and protect you from liability as you scale your investment business is simply to first acknowledge that you don't know what you don't know, and secondly, to make sure that you're working with competent professionals to ensure you're in compliance and maximize your growth opportunities. As a bonus, investment clubs can serve as a perfect solution for unlicensed professionals to compliantly aggregate capital without subjecting themselves to the burdens of securities regulation. Imagine how many people you know, or clients you have, or targets of your marketing campaigns that would love to be able to access better investments than what is peddled through your run-of-the-mill financial advisors and online brokerages. Wouldn't you like to be the only professional in their sphere who can compliantly provide them what they're looking for simply by setting up an investment club or even a feeder fund? And for you financial advisors who want to do better, how much would it help you differentiate your firm if you were able to confidently vet sponsors and provide your clients access to exclusive products that are demonstrably better by every established objective measure than what's recommended and sold by your competition. Now let's start bringing it all together. Buy side versus sell side. Sell side financial firms, such as broker-dealers, essentially sell ideas to their clients, and in most cases, these ideas are communicated for free. Buy side financial firms essentially have a pool of capital to use for investing, as is the case with RIAs and hedge funds. So we can say that sell side entities provide services to buy side entities. The goal of the sell side is to close the deal, whereas the goal of the buy side is to generate risk-adjusted returns that beat the market for their clients. A role for everyone. While it is illegal to act as a broker without a license, there is no prohibition on selling assets you own, whether they are physical properties or securities you issue. Further, interests in investment clubs are not deemed to be securities by the SEC, which means involvement in one does not require FINRA licensing. Everyone participates in the finance industry, from dumb money 401k owners and entrepreneurs to smart money shadow banks. What role are you going to play? How does it feel to know that you can access as much money as you can responsibly put to work in your investment business, and that your portfolio is protected from the next financial crisis? As an investment advisor, how does it feel to be able to afford your clients access to exclusive financial products that meet their income and growth needs with the confidence they won't lose when the markets take a hit? How will it help you grow your business being able to objectively measure and clearly communicate the merits of your advice? Both of those aspirations are attainable, but the only way to achieve either one of them is to actually apply the three secrets we've just discussed. The first, measure risk-adjusted performance to manage your investment portfolio to better performance than what is available anywhere else. Second, create a fund that allows others to participate in your investment portfolio's performance in ways that meet their individual investment goals. And third, legally issue shares or debt in your fund without fear of the regulators to profit from hundreds of millions of dollars in your portfolio. And if you're not a financial advisor and don't have a quality asset management business of your own, form an investment club to compliantly aggregate the capital of your network and clients and provide them access to better investments than what they can find anywhere else. Have a look at the ABL performance versus the industry benchmarks. Who wouldn't want to achieve that level of performance? From 2007 to 2015, we averaged 28.94% returns. But the real standout is 2008, 32.07%, when the S&P lost 37 and the REIT index lost almost 38. You're not going to achieve these results by following the herd of financial advisors or listening to other syndicators, and you're not going to friends and family your way to your growth goals. On the flip side, financial advisors can't protect their clients' downside exposure through random diversification, mutual funds, or by ignoring alternative assets. There's over $20 trillion starved for genuinely low-risk, fixed-income, real yield, and an escape from the ever-looming drop in stocks and questionable real estate funds. And no one is differentiating themselves with any substantive solutions. Now you can. What if you could capture 1% of that? $200 billion. It's there for the taking. What would that be worth? Would that be worth improving the way you do business? What about only 10 basis points? Would $20 billion be worth it? What about only 1 basis point? $2 billion? What about 1/100th of a basis point? That's 0.0001%. That's still $20 million. Worth it? The money is out there and desperate for objectively measured low-risk yield. How would that kind of growth change your self-image? Earning the sense of pride, knowing that you're doing things better, serving your investors in the way they came to you to be helped. I've just given you everything you need. If you apply it, do you think you'll be able to achieve your professional, personal, and financial goals? I've just given you the opportunity of a lifetime to bring merit to the finance industry. Why not do it and get a raise for your effort? So how many of you have had aha moments as we've gone through all this stuff? Are you feeling a little overwhelmed by all the new information I've thrown at you so far? I know there's been a lot we've gone over and fairly quickly. I've only had a couple hours to go over everything from risk engineering to the securities law you need to quickly and compliantly scale your business to 9 figures and beyond. Depending upon your current level of expertise, there's probably more that you'll need to master and implement the skills and information we've just gone over. And I don't want to just leave you here. I sincerely want to make the investment industry better for everyone involved. There's so much opportunity for improvement and growth. I know many of you come from very different backgrounds and have experience with different facets of various industries that participate in the financial markets. So to effect the greatest positive impact on the industry, we've developed a series of tailored solutions to meet each of your individual needs and goals. Would you be okay with me taking a few minutes to go over those solutions with you? Well, let's go. Everything we do has evolved from the perspective of the needs of the retail investor, and by extension, every merit-seeking investor. While the process may be complex, analogously to the iPhone, the end result is a user-friendly experience for all that cuts out the noise to address the needs associated with all three fundamental variables of investing: risk, return, and liquidity. Here's a summary list of the various market participants and the tailored solutions we've developed for each based upon their feedback to us over the years. I'll briefly go over each with you. First, for financial advisors, which includes family offices, RIAs, broker-dealers, and their due diligence officers. We provide third-party risk analytics services and client referrals, private structured products, feeder fund, and investment club services. For other financial professionals that are not FINRA licensed, like independent insurance agents, IRA custodians, accountants, real estate agents, attorneys, and relationship builders, we provide feeder fund and investment club services. Retail investors, that includes everyone from qualified purchasers, qualified clients, and accredited investors to non-accredited savers. We have our third-party risk analytics services, investment club membership for non-accredited individuals, and private structured products for high net worth individuals. For alternative asset managers and sponsors, such as real estate investors, lenders, syndicators, hedge fund managers, we provide third-party risk analytics and theoretical track record construction services and investment banking services for alternative asset managers. So diving into each one to provide a little bit of color. For financial advisors, our services are designed to address the two biggest problems you face: regulatory and legal liability, and the need to economically grow your client base. The variables considered by financial advisors and capital markets investors in their attempt to account for risk, such as asset class, diversification, offering cost structure, cap rate, geographic market, leverage ratio, etc., all contribute to the probability of an asset or portfolio losing value, but none of these things tell you the actual probability of loss. That's where we come in. We are able to measure the risk-adjusted performance of everything you touch, from each individual asset, public or private, to the portfolios you construct for your clients. We quantify the risk of your portfolios, vet sponsors, and asset managers, and identify risk-adjusted performance in new markets. Not only does that help you identify which assets are most likely to harm your clients, but it also allows you to clearly communicate your competitive advantage in objective terms. That's our third-party risk analytics services. And as we discussed earlier, Adagio Institute is a public charity dedicated to financial education, and Adagio Capital Management is a fund manager. We don't provide financial advice to the retail market, but the Institute's educational initiatives, such as this Masterclass, attract many retail investors looking for advisors who share our risk management perspective. As a part of our public service mandate, we have an obligation to send them somewhere. So we do, to financial advisors who demonstrate the ability to measure and manage risk with the same rigor we do. The advisors that we are able to identify with certainty that are doing such are the ones who utilize our risk analytics services. So they are the beneficiaries of these referrals. They are plentiful, and many are high net worth. Secondly, we create tailored and transparent private structured products that meet the risk-adjusted performance demands of your clients that can't otherwise be met. They are open-end, institutional-grade, risk-engineered, private fixed income and equity structures. They are constructed on alternative underlying assets. They generally possess a 12 to 24-month lockup period, although some may run longer. They generate positive alpha and low loss potential as measured since January 2007 or earlier, and they report quarterly, are audited annually, and utilize third-party administration. I want to emphasize that we are not in the business of selling funds. We're in the business of serving financial advisors and other intermediaries by providing third-party risk analytics services to assist them in gaining a meaningful understanding of the risk profile of the assets on their platforms and creating financial products that fill holes in their platforms with respect to performance and liquidity. This effort requires a two-way communication. You tell us what you have and what your clients need. We'll measure what you've got, and we'll do our best to construct what's needed to meet those needs. If all your clients are accredited, we can work with you to develop a feeder entity that allows for greater diversification of their alternatives portfolio. If you have unaccredited and non-qualified clients, we can work with you to facilitate the establishment of investment clubs that compliantly afford them access to quality private offerings that otherwise not be able to see. In other words, we're able to help you provide all your clients access to quality alternative assets. If you'd like, you can schedule a call embedded here on the Masterclass page to discuss how we can best help you serve your clients and differentiate your firm. Other financial professionals. How many of you have clients looking for an alternative to their financial advisor but feel limited in how you are legally allowed to help them? I know many of you were burned by the likes of Woodbridge and are fearful. Fearful of the repercussions of the harm done to your clients, fearful of potential legal action, fearful of the loss of revenue, fearful of how to evaluate similar offerings. We can help you assuage all those fears with the investment club structure. Investment clubs compliantly provide your clients access to exclusive investment products, further monetize your client base with a differentiating and high demand service, provide non-qualified clients and unaccredited investors access to quality alternative assets, and utilize Adagio's risk analytics services to measure the quality of the club's assets. Just like financial advisors, you can schedule a call with the embedded calendar when you return to the Masterclass page to discuss how we can better serve your clients by compliantly adding an investment club to your suite of services. As I mentioned earlier, it is the perspective of the retail investor that has motivated everything we've done since we got started in 2005 to address the shortcomings of the financial services industry and to provide investors merit-based, substantive products and services. I'm really proud of what we've been able to accomplish in that regard. By extension, any investor, including large institutional allocators seeking quality assets and objective, meaningful risk-adjusted performance measures, can benefit from our work. We can help you with our third-party risk analytics services to evaluate the risk-adjusted performance of any financial advisor, portfolio, or asset you are considering. Investment club membership for non-accredited, non-qualified retail investors and individuals. Provide exclusive access of the top 1% to the best performing alternative investments and exclusive and valuable investment educational materials. Private structured products for high net worth individuals and institutions allow you to boost your investment portfolio with measured, superior risk-adjusted performance. They're open-end, institutional-grade, risk-engineered, private fixed income and equity structures with alternative underlying assets. They've got a 12 to 24-month lockup period typically. They generate positive alpha and have low loss potential as measured since January 2007 or earlier. And they report quarterly, have annual audits, and utilize third-party administration. So you guys also are welcome to schedule a call to discuss how we can help you. To serve the investment needs of the public and institutional allocators, we help deserving alternative asset managers maximize their performance and reach their AUM potential. We provide our risk analytics services to seasoned asset managers, allowing them to communicate the merits of their portfolio in meaningful, objective terms. And we're also able to construct theoretical track records for newer asset managers who have the skill but lack the experience. To construct the theoretical track record, we translate your investment model into a comprehensive set of rules and identify every possible variable associated with those rules that contribute to your overall performance. From there, we plug actual historical data going back to at least January 2007 into each of those variables and weight them accordingly to determine your theoretical historical returns. From there, those returns can be analyzed to determine your risk-adjusted performance characteristics for marketing and distribution purposes. As a simple anecdotal example that highlights the rigor of our process, in the case of real estate developers, we dive all the way down into the statistical relationships between their contractors' build estimates and actual times and costs to construct to measure construction risk. The effort we make is comprehensive, and the result is that we provide all asset managers the ability to report their performance regardless of their tenure in truly meaningful, comparable terms. On the investment banking front, qualified asset managers and real estate investors are able to hire us to implement our expertise on their behalf, do all the work for them to form and distribute a dedicated fund or structured product that fully capitalizes their business, and incur the licensing and regulatory burdens that otherwise be responsible for. We consult with them to refine their investment model, capital structure, and operations to become responsible stewards of the public's money and achieve marketable performance. We construct that theoretical track record as needed and backtest it. We securitize their business through the creation of dedicated funds and structured products and build the distribution required to sell those funds and products through the appropriate channels to meet their capital needs. As you might imagine, it's a relatively expensive endeavor, generally upper six figures, even seven figures, and it can run much higher depending upon the complexity required to get through that process and reach the target AUM, whatever that is. This is the only service of its kind and well worth the effort to raise hundreds of millions of dollars. And even better, as I mentioned earlier, all upfront expenses incurred by our client asset managers are reimbursed by the structures we create to capitalize them at a rate that can be economically supported by those structures. So the result is that the entire process becomes ultimately free, as our clients only have to float the cost for a finite period. If you'd like, you can schedule an introductory call with the embedded calendar when you return to the Masterclass page to discuss our risk analytics services or apply for our investment banking platform. As a token of my appreciation for all of you making the effort to complete this Masterclass, I'm making myself personally available to at least the first 15 qualified financial advisors, professionals, passive investors, and asset managers we've just discussed who schedule a call through the calendar on this Masterclass page. I'd love to be able to talk with all of you, but my time constraints are fairly intense, as you might imagine. All that being said, I know many, especially those just starting out, aren't ready to engage us yet. But I genuinely want to see as many market participants as possible doing the right things to dramatically improve their investment portfolios and in the process, change the industry for the better. So I took a great deal of time to put together a package that would allow those who can't afford our services everything they need to be successful. I know it takes size to have significant influence, and I know what's needed for you to achieve size on the scale of 9 figures and beyond. I've seen it, and I've done it. Would you be okay with me taking a few minutes to go over that package with you? Okay, let's go. We've done our very best to assemble everything you'll need to implement what we've discussed as a do-it-yourselfer, from educational programs and template documents to one-on-one support from me. We call it the Shadow Banker's Secrets Program, and it's incredible. The first thing I put in it was the Masterclass, how to compliantly raise unlimited low-cost capital without having to ask for it. While the short title references investment banking and real estate, it's applicable to any asset class or securitized portfolio. It's a 2.5-hour video class with downloadable slides that gives you a high-level overview of the what that's required for raising unlimited low-cost capital as an institutional-grade fund manager. It covers a lot of the stuff we talked about here today, but with more of a real estate bent. It's really meant to serve as an introduction. In addition to the Masterclass, I've developed the AIP course on the Blackboard platform, the same platform used by most major universities for their online courses. So while the Masterclass gives you the what, the AIP course gives you the how. It contains a lot of information, and you can approach it a couple different ways. You can either treat the course as a reference, looking up what you need as you need it, or you can go through the whole thing in sequence and come out the other side as an accredited investment professional designee. Financial advisors who achieve the accredited investment professional designation, like our risk analytics clients, are eligible to be referred clients by the Institute. The AIP course covers much of what you'll find in the thinner Series 65 exam manual, except with much greater emphasis on private securities law, risk measures, and real estate as an asset class. The Series 65 doesn't really cover real estate. It doesn't say much on private securities law either, and it's got nothing substantive on risk-adjusted performance analysis. I've got the manual exam right next to me. It's about 800 pages. There are like 2 on private securities law and 1 on REITs. The little mention that's given to risk-adjusted performance measures includes no numbers anywhere to be found. It's no wonder why trying to distribute private structured products through investment advisors can be such a challenge. The AIP course does not go into great detail on publicly traded securities and advisor compliance, but it does cover enough so that you can compete with publicly traded assets and distribute through traditional channels. So the Masterclass is all me for 2.5 hours, but the AIP course provides additional perspective and valuable color to the text with videos from reputable real estate, finance, and legal experts to make the topics a little more clear and easier for you to grasp. It covers all the components of investment banking and fund management that you'll need. You'll learn exactly what money is, where it comes from, and how it's created. You learn how to convert your investing effort into an asset you can sell, how to create quality investment assets from thin air. You'll learn what other type of investments you're competing with, their role in the market, and how to beat them. Learn how to have people begging to take their money with no personal guarantee and no applying for loans. And ultimately learn how to build wealth just like a bank, which represents the real shift in mindset for most people. Are you getting this? So here's the content of the AIP course. Like I mentioned before, you can go through it sequentially, or you can use it as a reference for specific topics as you need them. Regardless of how you choose to use it, syndicators and fund managers will be able to reduce their legal bills by thousands of dollars. Real estate investors will be able to reduce their capital outlay for acquisitions by thousands and even millions of dollars. Good financial advisors and capital aggregators will be able to eliminate thousands of dollars in waste from their marketing budgets with substantiated and differentiated messaging and product offerings. Retail investors will be able to save tens of thousands of dollars, if not hundreds of thousands of dollars, in fees charged by unscrupulous financial advisors in shitty mutual funds, not to mention the increase in portfolio gains they'll see. In short, the course is designed to further help you implement all 3 of the shadow banking secrets we covered. Remember, we charge hundreds of thousands and even millions of dollars to teach and implement this stuff on our clients' behalf. You could pay other expensive professionals to provide you bits and pieces of what's included here, but for much of it, there simply is no amount of money that you could throw at anyone else to solve these problems. How much is it worth to be able to start a new investment model and replace having no experience with a marketable theoretical track record? Where else could you possibly go to learn this or have it done for you? Where else could you go to become an authoritative creator of institutional grade financial products? You can't even get that with an Ivy League MBA or a CFA. What would it be worth to be able to sleep at night knowing your life savings is in a place where you don't have to be in constant worry about the markets? I guarantee if there was any other place to go for that kind of peace of mind, you'd be there already. One basic tool I've included is a mortgage amortization schedule. It's probably worth noting that it's not just useful for amortizing mortgage loans. I find it helpful when amortizing any expense or loan. I've also included an income analysis template, which is designed to value assets from a purely income perspective. This is obviously helpful if you base your investment model on the income of any given asset, such as residential property, like we discussed earlier. Of course, it outputs values such as return on equity, cash flow, and break-even analyses and scenario comparisons, but it's also fully editable. You commercial real estate guys will likely have something similar, but this offers a slightly different and valuable perspective. For those focused on the residential space, single-family to fourplex buildings, this income valuation template will help you determine the most you should be willing to put into any given property. This template captures vacancy-adjusted gross income as opposed to just raw gross income, and allows you to set your target cap rate so that you can determine what a responsible basis looks like. When you operate like a private bank, you can let this output determine how much to invest in a property as opposed to subjecting yourself to market cap rates like most investors do. I've also included a case study that explains from cradle to grave how one large multifamily operator, which happens to have been our first advisory client, went through just about every problem you could imagine, and the plan we developed to get them back on track to compliantly raising $5 million per month. They ran through hundreds of thousands of dollars to solve their problems, and I'm providing you the solutions, step by step. They were a turnkey multifamily operator in business for over 10 years that stabilized blighted properties for resale at market value. All properties, rehab, and holding costs were financed entirely with debt raised from the public, both accredited and non-accredited investors, averaging 150% LTV at a 15% rate of interest. They came to us with approximately $40 million in real estate assets under management, and the stabilized assets had negative equity. They were upside down. The NOI did not cover their debt service, and they were also under investigation by 3 state securities administrators and the SEC. As a result of working with us, they were able to cease illegal capital raising efforts and negotiated a financial restructure of the existing portfolio. They amended their valuation process to insulate their investment portfolio from market cycles, and they raised capital at a rate of $5 million a month through 4 funds. Just about any challenge you could possibly be facing in your business right now is addressed in this case study. It's like a roadmap for implementing the AIP course and reaching your goals. Wouldn't that be helpful to guide you on your path? Now, it's probably a good time to take a moment to give everyone a chance to catch up. I expect that it might get confusing for some of you to determine where you fit into all this. There's money flowing in, there's money flowing out, there are investors running an investment business, and investors who simply buy passive debt and equity instruments. Investments are being created and distributed through widely varying channels, and meanwhile, real estate and financial services people use a completely different vernacular to describe similar ideas. I'm going to clear all this up once and for all right here. What I've been describing is the entire financial services industry and all its participants, which includes literally everybody. Every single individual on the planet participates in one way, shape, or form, whether they want to or not, from those who stash cash under their mattress, every employee with a 401k, and anyone who's ever borrowed money, to real estate investors, financial advisors, and fund managers. The whole point of this presentation is to thrust you from wherever you currently are to the top of the industry, utilizing your specific skills and resources as an informed master of your financial domain. So who can benefit from all this? Alternative investment sponsors, including real estate investors, asset managers, lenders, and syndicators, new or old, who want to protect their business from the next market crash, or who want access to unlimited capital to execute their investment business on their own terms. Retail investors and savers, those who aren't financial experts, such as retirees, who have a nest egg they need to generate decent income from or grow, who can't afford much risk exposure, and who want to meaningfully improve their portfolio and or replace their financial advisor. Financial professionals, who want to create competitive advantage by incorporating reliable, quantifiable investment risk measures and alternative assets that generate demonstrably superior risk-adjusted performance into their practice. Real estate agents, who want to compliantly serve their investor clients in search of returns that are not available via the MLS or CoStar, are in need of 1031 assets, or prefer quality passive investment opportunities, and want to develop a niche as the investment real estate consultant in their market. Independent insurance agents, IRA custodians, accountants, and attorneys who want to compliantly serve their clients in need of better investment options than what they are being offered by their financial advisors or otherwise have available through their retirement accounts. And relationship builders who want to serve and monetize their network by compliantly providing exclusive access to high-quality alternative investments, like top-performing hedge funds. Anyone in any of these groups can start their own fund or fund of funds. Anyone can form an investment club, and anyone can invest in someone else's fund. The question is simply which role are your skills, interests, and resources best suited for. Regardless, all these roads lead to the same place: true financial independence. Are you getting this? Now, if I had to guess, I'd say the area where most people need the most help is with the math. The risk calculations can get pretty complicated. So the first thing I did was to build out all the significant risk-adjusted performance calculations in Excel. Excel spreadsheets can be a little difficult to hand over to others without having things break. So I hired a developer to take every calculation and output from the Excel spreadsheet and convert it into a user-friendly web application that scrapes current market data and updates in real time. Because it's a web application, it works on any platform, Mac or Windows PC. I'm really proud of this. I don't know of anywhere else you can find these calculations automated in one application, especially with such a user-friendly interface. So I'm giving you the risk-adjusted performance calculator. It incorporates every significant risk-adjusted performance metric, including illiquidity premiums for private securities, so that you can easily compare any asset, from Apple stock to hedge funds to individual real estate assets, in meaningful, objective, apples-to-apples terms. You'll see these calculations in the AIP course, but you don't have to learn how to do them yourself. Just plug in your annual return numbers and voila, an instantaneous output of the risk-adjusted performance ranging from a simple color code to a breakdown of each component metric. And it even includes the illiquidity premium for private securities so that you can compare institutional grade private funds and structured products apples to apples with publicly traded assets. As I emphasized earlier, a minimum of one complete market cycle of performance data must be evaluated to generate any meaningful quantitative measures of risk. It's for this reason that the risk-adjusted performance calculator requires the return data input to encompass 2007 or earlier. I understand that many asset managers haven't been around that long. That's where our theoretical track record services come in, and could be valuable for the newer firms and funds. Are you getting this? This tool is invaluable. It cuts through the bullshit peddled by everyone from real estate syndicators to financial advisors to meaningfully measure investment quality in objective terms. You'll no longer be susceptible to the propaganda that governs the industry. It allows you to choose the best assets for building a portfolio, whether you're acquiring real estate or you're an investment advisor assembling assets for risk-conscious clients. Investment advisors and fund managers can also use it as a tool to objectively report the quality of their portfolios and communicate to their clients in clear, objective terms. There's nothing like this available anywhere else, and it's a must-have for every serious investor and investment professional. In addition to the how to operate an institutional-grade asset management business, you'll probably also need templates to guide you in creating corresponding institutional-grade documents. We've paid hundreds of thousands of dollars to have marketing and offering documents drafted to a standard that they'd be respected by the biggest financial institutions in the world, and we're giving these templates to you. The two-pager, the pitch deck, offering memorandum, operating, and subscription agreements. So all you have to do is swap out any fund-specific information with that of your own. You want to have your docs reviewed by competent securities counsel to make sure everything is clearly consistent with your intent and compliant before you start distributing them, but not having to have these docs drafted from scratch will save you tons of money. The good news is that when you do it right, you can pre-sell your fund with the marketing documents before you pay to have the offering documents reviewed. This prevents you from unnecessarily spending any money without first knowing whether you'll be able to sell shares in the fund. You can use these documents to set up funds for your own investment model, or if your greatest asset lies in relationship building and you don't have an investment model of your own, you can use these documents to create a fund of funds that allows you to aggregate capital to invest with other asset managers. When you've structured your business and investment model properly, the offering documents become actual assets with value in and of themselves. These documents are actual securities that are the private counterpart to publicly traded assets like stocks, bonds, mutual funds, and REITs. Let that sink in for a minute. You're able to print actual assets with value. Just like the Federal Reserve creates dollars in their system that are printed by the Treasury, you're able to create valuable securities that can be printed and sold in $1 million plus tranches. So now the question simply becomes, how many assets are you able to print? I also thought it would be helpful to aggregate all the relevant securities laws in one convenient place for reference. So they're all aggregated within the resources section of the AIP course. The Securities Act of 1933, the Securities Exchange Act of 1934, the Investment Company Act of 1940, the Investment Advisors Act of 1940, the Dodd-Frank Act, the Jobs Act, Uniform Securities Act, State Securities Administrators, SEC Rules and Regulations, the SEC No Action Letters, SEC Form D, and SEC Form 8EV. Even with all that, I know that at some point you're going to still have questions. Each of you has different interests, skills, and resources, and may want some guidance on applying everything we've discussed to develop an approach perfectly tailored for you. My billable rate is $975 an hour, but I'm going to give you 5 one-hour private phone consultations to help you through any sticking points you may come across and maximize your potential for success. You'll probably want to save them until after you've gotten through all the materials I'm providing you first, but that's your call. It's yours to use whenever you'd like. If you're just starting out, your theoretical track record will be very helpful, but it will also be helpful to have some money behind you. Upon successfully completing the AIP course, we'll provide you a $5 million proof of funds letter to give you the strength and credibility to sit at the table with just about anyone. For real estate asset managers, it should go a long way to help you get just about any property you find under contract. So we've got the Masterclass in Investment Banking and Real Estate. That's a $199 value. We've got the Accredited Investment Professional Course Designation. That's a $4,995 value. We've got the Amortization, Income Analysis, and Valuation Templates, which are a $250 value. We've got the $5 million per month capital raising case study, which is a $150 value. The Risk Adjusted Performance Calculator, 1 month free access, $750 value. Sample private offering documents, $185,000 value. Aggregated federal securities laws and forms, $100 value. 5 one-hour consultations with me, it's a $4,875 value. And a $5 million proof of funds letter, it's at least a $5,000 value. So we've got over $200,000 of value in educational materials, documents, and tools. Is everything you need to scale your investment business by hundreds of millions of dollars worth $200,000? Adagio's clients are putting up over $750,000 for us to implement these skills for them, plus millions on the back end. It should be absolutely obvious by now that what we're offering is better than any other approach you could possibly imagine to raise money, grow AUM, and protect your portfolio from market crises. This is the way. And Adagio Institute was established to practically give it away. Adagio Institute is a 501c3 public charity dedicated to financial education. Its purpose is to help the public navigate the propaganda of the finance industry, to provide financial professionals who recognize the shortcomings of the industry an opportunity to do better, and to help deserving asset managers access the capital they need to responsibly scale their business. Subsidizing this offer is one of the most effective ways the Institute can help fulfill its mission. It's obvious why this package is a good deal at $200,000. The business of finance is just expensive. There's no way around it. But $200,000 is still out of the reach for many deserving people. That's why Adagio Institute was created, to provide access to exclusive financial knowledge and resources to as many people as possible. So as a public charity, we're able to create packages that do just that and subsidize a vast majority of the cost. I'm happy to announce that at this moment, we're able to offer this entire package for only $6,725, and I feel really good about that. I'm so confident what this package can do for you and eager to get these skills and resources out into the marketplace that if you sign up today and if you're not satisfied for any reason, or if you decide that becoming your own bank is simply not for you, just let us know and we'll refund your money. You've got 30 days to go through everything and begin applying the materials. If at any time during that period you don't like it, that's it. Just let us know and we'll get you your money back. You can keep the templates and any other downloadable assets that are included. We're a public charity and the sole purpose of our existence is to help you, and by extension, the public at large. I don't know how to make the process any more accessible. One of the objections I often hear, even from some of the smartest and most driven people you're going to meet, is, I'm just starting out and I need more experience before I'm ready for this advanced stuff. If you are serious about investing, it's never too early to learn the fundamentals of professional finance. This is a quote from one of our clients that I think really drives the point home. Then, if I'd spoken to you 12 months ago, it would have been a lot easier. I thought that I wasn't ready for this complicated stuff, and that understanding real estate investing and syndication was all that I really needed. But the truth is that if I had started out running my investment business the right way, instead of thinking I needed to grow what I already had first, it would have been much easier to start accessing the capital I needed when I was ready. Now I have to go back and rework all the problems I didn't even know I was creating for myself. I'm just glad I have the chance to fix the problems I created before the market ruined my business. It's never too early to start doing things the right way. Like I mentioned earlier, this offer was structured specifically for those who aren't ready for us to take them on as a client. You've got the Masterclass, the comprehensive AIP course, the templates, the case study, the calculator, the sample documents, the aggregated securities laws, 5 hours with me, one-on-one, and a $5 million proof of funds letter, $200,000 plus value that we're able to subsidize and provide for $6,725. So to get started, just click the red button on this Masterclass page. As I promised at the beginning of this presentation, I'm going to go over the 3 economic rules that govern how we all do business: the consumer, the producer, and the banker. Understanding this dynamic will make you rethink your place in the economy and how you want to position yourself to earn money. The consumer provides labor to the producer. The producer creates and provides value that the consumer buys. The banker provides the producer money via debt and equity to operate his business. The banker also provides the consumer money via interest-bearing loans to buy from the producer. While the consumer is constrained by the time he has available to sell to the producer as labor, and the producer is constrained by the value he is able to create and provide the consumer, the banker is making money from both the producer and the consumer by providing them nothing more than money. And as we have discussed over the past couple hours, the banker is able to effectively create that money from thin air. The consumer lives his entire economic life as a servant to the producer. He chooses what to learn and how to spend his time almost entirely based upon the demands of the producer. The producer has to create real, tangible value that consumers are willing to buy. This is a high-risk, capital-intensive effort. Meanwhile, the banker makes money simply by providing money to the producer and the consumer. What expertise must each of these have to fulfill their roles? As I mentioned, the consumer has to master the specific skill that's in demand by the producer. The producer must be a master of building systems that can produce value in an economically viable way. And the banker must be a master of banking and financial strategies, the very expertise I'm providing you. This dynamic between the 3 economic rules was eloquently summarized in an epigram from Great Britain quoted in John C. Bogle's book, Enough. Some men wrest a living from nature. This is called work. Some men wrest a living from those who wrest a living from nature. This is called trade. Some men wrest a living from those who wrest a living, from those who wrest a living from nature. This is called finance. And this is the nature of mankind. Every social reset in history has defaulted back to this dynamic. So if these are the three options we have to choose from, which one do you want for yourself? If you haven't chosen to be the bank by now, how much of your life will you continue to choose to give up to those who have? You're not just giving up money, but you're forfeiting your time, your value, and ultimately control over your destiny. I want to sincerely thank each and every one of you for taking the time to complete this masterclass. I know it was pretty dense, but I hope you found it incredibly valuable. That was my intent, to take everything I know and distill it into one concise format that would serve each of you on your journey for financial independence. For the seasoned financial advisors, professionals, passive investors, and asset managers who would like to take advantage of our tailored solutions, schedule a call with me on the calendar. And for those who aren't quite ready to work with us yet, or who want to take a stab at the do-it-yourself approach, click the red button, get the Shadow Banker Secrets program, and begin implementing these skills and resources. Remember, you've got 5 hours one-on-one with me to help you along the way. So again, thank you. And I hope to talk with each and every one of you at some point along your journey.